Okay. So we'll be able to identify the circumstances in which transactions actual or proposed considerations must be tested against the concepts. We'll be able to understand how the UAE transfer pricing has been aligned, the various regulations that have been issued. We'll be able to identify, recognize situations in which rules could apply for the transfer pricing. Uh, what rules to apply. We'll also understand financial consequences of the rules, and lastly, understand the circumstances in which CBCR, country by country reporting, is required, and naturally how we prepare that report. You'll need to give me 1 minute. Right. So moving on now, let us have a look into the international framework. So naturally, you might have heard that there is a very detailed guidance, a separate document issued by OECD uh, on transfer pricing, which is famously known as the OECD Transfer Pricing Regulations or Guidelines, TPGs. So a few concepts have been introduced through those transfer pricing guidelines. For example, the first of them is multinational enterprise. So, uh, a multinational enterprise, it's a 30-year-old debate. Uh, the role in the world trade hasn't continued to improve over the last few decades. So let me give you an idea. Like the whole point is that it started from World War II, actually, the end of World War II, when the economies were collapsing, and especially in Europe, the traders or businessmen, they understood that new taxation is coming in, but there is no rule or law which taxes an entity which is not even incorporated in a country. So the neighboring country traders would enter the that country and start selling, and they would cleverly avoid tax. That's something that was the beginning of this view by the revenue authorities, that we need to tap this matter. That's how the whole concept of permanent establishments started to come in. So, and these enterprises naturally were gradually called multinational enterprises. So it's a complex taxation area. Actually, uh, the issues primarily arise for practical difficulty, both for MNEs and the tax administration, to make sure to determine the income and expenses of a company of that relates to that permanent establishment, where the company itself is not incorporated, but the business presence is already there. That is what is usually called a permanent establishment. So it is that part of an M&E that should be taken into account within a jurisdiction. Wherever the word jurisdiction comes in, that means country, effectively, particularly where the M&E group's operations are highly integrated. So let us have a look at two of the major discussions for the tax administration. Specific problems arise for both policy and practical levels. So let us have a look at the policy level problems. At the policy level, jurisdictions need to reconcile their legitimate right to tax. So this word, this expression, taxing right, that's a major issue around the world. That's something that the OECD has been addressing for quite some time. So the legitimate right to tax the profits of a taxpayer based on the income and expenses that can reasonably be considered to arise within their territory. So, with the need to avoid taxation of the same item of income by more than one tax jurisdiction. Now, the problem will be that somebody from India or other Pakistan or other country comes into UAE representing their company that is incorporated in India, And UAE Federal Tax Authority says, okay, this we will look at this business operation as a permanent establishment of that Indian company. So we are going to tax it here in UAE. But the problem is that the taxation laws in India, it is quite likely that they will tax the entire worldwide operations, and so that UAE level revenue will also be taxed in India. That is something which is called double taxation. This gives rise to double taxation. Such double or multiple taxation creates an impediment to cross-border transaction in goods and services and the movement of capital. At a practical level, a jurisdiction's determination of such income and expenses allocation may be impeded by difficulties in obtaining pertinent data. So, this is where the transfer pricing rules come in, and income attribution is provided, and double taxation matters are also arise into it. So policy has to be made to attribute the income and expenses in the right manner, and to have mechanism where such double taxations also may be avoided, so that the enterprise can tax it once. Another primary level consideration, at a primary level, the taxing rights that each jurisdiction asserts depend on whether the jurisdiction uses a residence-based approach, source-based approach, or a combination, or both systems of taxation. Now, I think some people have already joined. So Mujaddid is also here, Farjad has also joined. So let me ask this question. Uh, what, in your view, is source-based taxation? This is a question that we have discussed before. I'm going to repeat this. What is the difference between source-based taxation and income and residence-based taxation? Can somebody tell me the difference between residence-based taxation and source-based taxation?
Uh, Residence-based taxation means like where the company is incorporated, or where the place of residence is. And the source based is where it's generating the income. So, uh, for example, where is the source of income generation? It can be in the country of incorporation. It can be outside the country of incorporation.
Okay, for example, let me counter question you, Mujaddid, right? It was Mujaddid that answered.
Yes.
Ah, let me counter question you, Mujaddid. So let's say you have a company in UAE, okay, and you sent one of your directors to, let's say, Oman, okay, and you don't have a company in Oman, right? And the director started doing business in Oman, started closing deals in Oman, right? UAE taxation law says that any company that is incorporated in UAE, their worldwide level income will be subject to tax. Am I right?
Yes.
So that income which that director earned in Oman, that will be taxed in UAE, also taxed in UAE. Am I right? Because worldwide income is taxable,
Yes.
right? That income, from a UAE's perspective, what will you call it? Is it a residence-based approach of taxation that the UAE has, put onto the resident companies, or would you call it a source-based taxation from a UAE perspective?
Uh, it's a residence based.
Okay, so can I ask this question to others as well? Like, uh,
The,
what? Yes,
the source base.
it is source-based. Okay,
Yes.
Mr. Tanu, what do you feel? This income that is being that originally in happened in Oman, but it has been subjected to tax in UAE by force by the Federal Tax Authority. Is this approach is residence-based taxation or source-based taxation?
No clue, dear. No clue.
No clue. This is actually residence-based taxation. It's basically show of force. Basically, if you think about it, really think about it, residence-based taxation is a show of force. Why? Because the authority is saying, since you incorporated in our country, so your worldwide income is subject to tax in this country. Okay, so this is residence-based taxation. But Oman will also tax that income in Oman. Why? Does that company have a residence in Oman? Residence. Remember what my words.
No.
No. That company is a resident company of UAE, if you really think about it. Only one director is present there. So Oman is going to tax that income in Oman as well. And would you call that a source-based taxation or resident-based taxation from Oman tax authority's perspective?
That's a source base.
That's not
Exactly.
supposed.
That's a source-based taxation. But you'll be surprised that in Oman as well as in UAE, both approaches exist. It's a combination of residence-based taxation and source-based taxation. So when that director is in Oman, the Oman tax authority is going to ask that director to register this business presence as a permanent establishment. Under the laws of Oman, that director would probably need to take a branch trade license, most probably. Same thing goes in UAE as well. So ideally, I mean, if there may be some loophole in the law where you might not need to take that trade license, but doesn't exclude taxation on this income. In Saudi Arabia, there is one category which is called permanent establishment itself that has been provided in the tax law. So this is like a registration method or modus operandi. So there can be one category of registration in the ZATCA, Zakat and Tax Authority of Saudi Arabia, where the status would be permanent establishment. So that's a very good way. That's a broad way to tap this. So that branch will be subject to tax in Oman, and that will be Oman Tax Authority taxing that company as a source-based taxation. But tomorrow, if the director told the Indian shareholders that, guys, why don't we actually set up an entire company in Oman? So and they agreed, and the company was set up in Oman. Then that company will be a resident company of Oman, and the resident-based taxation rules will apply to that company. So generally speaking, this is the difference between the two approaches. Now, coming further to this was basically the summary of this point. OECD member countries have chosen a separate entity approach as the most reasonable means of achieving equitable results and minimizing the double taxation risk. So when we say separate entity approach, that means permanent establishments are treated as if they are separate entities, in short. Okay, that's how it is. In order to apply the separate entity approach to intra-group transactions, individual group members must be taxed on the basis that they act at arm's length transaction. Now, please remember, transfer pricing happens between associated enterprises of the same group. Okay, so let me ask another common sense question. In a group of companies which are where entities are under common control, what are the tax frauds that are possible? There is regular sale purchase transactions happening. One group entity is doing all the purchasing for other group entities. Other group entities are basically purchasing the goods from that particular entity. Okay, so what could be the first thing that could come to your mind, that in the transactions of sale and purchase, what could be the thing that could
Under
happen?
underpricing,
Or overpricing?
overpricing. Yeah.
Both things. So there is a possibility that the sales transaction from the purchasing entity by buyer entity, they may either underprice the goods or overprice the goods, right? But the transfer pricing regulations basically stress on the need to keep these transactions at arm's length prices. Okay, that's why, because under these rules, the onus of taxation should fall in a fair manner on both entities. So under the transfer pricing rules, which is the international rules, what is the word that they use between for such group companies? Can somebody tell me what is the wording under the international rules, not UAE rules? Under the international rules, what words do they use for such companies?
Related parties.
No, that is the wording used under the UAE corporate tax law.
Okay.
Under the OECD's transfer pricing guidelines, such companies are known as associated parties or associated companies, enterprises. The right word is associated enterprises. Okay.
Okay, so
Uh,
I have one more question related here. I read they are also here in UAE using as a connected person. So what's the difference between a connected person and a related party?
so connected person essentially is a human being. So it's a human, the broadest meaning of it is a human being who's either a shareholder, owner, or even a director, or a major office holder, such as the chief executive officer or chief financial officer, C-suite basically. So these people are in a position to influence the company. These people can get undue benefit from the company, or extend undue benefits by their own powers. So that is why these persons are known as connected person. There are more things associated to this definition. I have given you the gist of it. There is a few more things, but for your remembering purposes, think of it in that manner. I hope that clarifies.
Okay.
Okay. So anyways, the relationship among members of the M&E group may permit the group members to establish special conditions in their intra-group relationship that differ from those that would have been established had the member companies acting as independent enterprises. This is exactly what happens. So they can establish a different type of relationship which may not reflect open market conditions. To ensure correct application, the separate entity approach, OECD member countries have adopted arm's length principle. Now, let us talk a little bit about the international taxation principles. These international taxation principles have been chosen by OECD member countries as serving dual objectives of securing the appropriate tax base in each jurisdiction. This word tax base, what does that mean? Can somebody tell me? Appropriate tax base in a particular country in each jurisdiction. What does tax base mean, Mujaddid or Farjad? Anybody? Very simple. Tax base is the amount on which tax would be applied. Okay, the tax rate will be applied. That's tax base, the taxable income. Okay. Uh, in each use, avoiding double taxation, thereby minimizing conflict between tax administrations and promoting international trade and investments. So if you apply the taxation rules, international taxation rules appropriately, people will not be afraid to do cross-border transactions or have their presence in cross-border. Otherwise, they'll be always afraid that there will be double taxation coming to them, or tax base will become different, or unfair, and more tax will be applied to us in another country. So they will be afraid. So international trade will be damaged because of unfair taxation. So these rules help to avoid that situation. These principles concerning the taxation of M&Es are incorporated in the OECD Model Tax Convention on Income and Capital, which forms the basis of extensive network of bilateral treaties. So this document, OECD Model Tax Convention on Income and Capital Gain, was issued in 2017. Actually, it was issued before that, but quite a few countries of the world basically signed this document in 2017, and that's why this document is dated as 2017. As of today, I think 139 countries have adopted this model tax convention. So why the word model? Model, the reason for using this word is actually, if you really look at this document, you'll find that it is a sample of double tax agreement. So it's a model of double tax agreement, that this is how a double taxation agreement should be written between two countries. That's why it is called a model tax convention. So in this model tax convention, 32 different headings are there, different aspects of taxation are there that have been addressed in this document. Now, why, if that is the case, then why this document, model tax convention, is 758 pages long? The reason is that although the size of a double taxation agreement may be hardly a few pages, 2, 3, 4 pages maximum, right? But in order to explain to the world as to what these small paragraphs mean and what are so many different philosophical explanations and technical explanations around it, there were commentaries and summaries written on that document. So very detailed explanations provided. So each of these provision is addressed over a very large, in a lot of detail, 50 pages or 100 pages sometimes. Discussion and summary has been prepared on it from citing aspects from around the world, all possible dimensions. That's why this model tax convention provides explanation and summaries on those 32 different provisions. Main mechanism for resolving issues. The main mechanism for resolving issues that arise in the application of international tax principles to MNEs are contained in these bilateral treaties. The articles that chiefly affect the taxation of multinational enterprises are, now we are going to know about these articles. Article 4 of this model tax convention addresses the concept of residence. Like again, this is a document which is an international document and it is a model document. Respective countries may have laws which may differ from from the provisions of this model tax convention. But please remember that once a double taxation treaty or double tax agreement is signed between these two countries, usually majority of these countries are signatories to the Vienna Convention on the Vienna Convention on treaties. So that Vienna Convention, there is a clause in that, there is a provision in that agreement which says that wherever there is a conflict between a bilateral treaties between two members who have signed this Vienna Convention, then that bilateral treaty will override the domestic law. Guys, this is such an important point for us to remember, that you will understand the repercussions as we go forward. That let's say tomorrow, under the double taxation agreement, one particular relief has been provided to the contracting states, the businesses that are incorporated in one country or the other country, and that business claims that relief under this double taxation agreement. But the interesting situation is that the domestic tax law has a different treatment for that relief. Then which of the two sets of laws is going to win? The domestic tax law will win or the double tax agreement will win? The answer is double tax agreement. Why? Because the double tax agreement signed under the Vienna Convention trumps the domestic law. It overrides the domestic law. So anyways, first topic is residence. Article 4 defines it. Article 5 and 7, which determine the taxation of permanent establishments. Okay. This permanent establishments is one example I gave you. There are other ways as well whereby a permanent establishment may be constituted. Then there is Article 9, which relates to the taxation of profits of associated enterprises, which Mujaddid called related parties. Why? Because under the UAE corporate tax law, these have been addressed as related parties. Associated enterprises meaning where one enterprise significantly influences or controls the other enterprise, that's an associated enterprise, and applies the arm's length principle. So Article 9, remember. Sometimes in this course, when we are in the knowledge check or whenever you are taking in the actual exam for this course to be certified by the ACCA, uh, it sometimes is a test of memory, so that we should account for. So these articles, remembering the articles may help you. Article 4 is residence, 5 and 7 permanent establishment. Article 9, which relates to taxation of the profits of associated enterprises and applies the arm's length principle. So Article 9 will be associated enterprises. Article 10 and 11 and 12, three articles, they determine taxation of dividend, interest, royalties. So now going forward, like from Article 10 onward, we have gone to the income statement level respectively. And then we have some administration related article 24, 25, 26, which contains special provisions relating to non-discrimination, dispute resolution, and exchange of information. So the last part of the model tax convention, article 24, 25, 26, they address non-discrimination, dispute resolution, and exchange of information. So there is a committee called Committee on Fiscal Affairs. Mainly tax policy body of the OECD, which has issued a number of reports relating to the application of these articles to multinational enterprises and to others. The committee has encouraged the acceptance of common interpretations of these articles, thereby reducing the risk of inappropriate taxation and providing satisfactory means of resolving problems arising from these laws, etc. So this Committee on Fiscal Affairs, this provides guidance, it writes reports, etc. on the application of the articles. Transfer prices. Now let us understand, generally speaking, there is a notion, a common belief that the word transfer pricing is a bad thing. That is a wrong notion. Transfer prices are the prices at which an enterprise transfers physical goods and intangible property or provides services to associated enterprise. It's as simple as that. So if you really think about it, the word transfer price is a neutral word. It can be good, it can be bad. The application of it can be good or bad, either way. It can be fair or unfair. An associated enterprise is an enterprise that satisfies the conditions under the Article 9 of the Model Tax Convention. Under these conditions, two enterprises are associated if one of the enterprise participates directly or indirectly in the management, control, or capital of the other, or if the same person participate directly or indirectly in management, control, or capital of both enterprises. So basically two companies are there and one shareholder controls both companies. So those two companies will be seen as associated enterprises. Or let's say that we are ignoring that third party who's the shareholder. There are two companies and one company directly owns the other company or controls the other company. These two companies will be associated enterprises. Both models are possible. One is a pyramid model, the other one is a line. That is, both enterprises are under common control. Transfer prices are significant for both taxpayers and tax administration because they determine in large part the income and expenses and therefore taxable profits of the associated enterprises in different tax jurisdictions. So why transfer pricing rules are important? Because through these rules you are selling from UAE to Saudi Arabia. So in Saudi Arabia, a company is buying means they are recording an expense means their profit is going down. What will be the concern of Zatka? Oh gosh, this company, Saudi Arabian company, which is purchasing from their own group company in UAE, is playing a game with us. They are overpricing, the UAE company is overpricing the transaction, and our company in Saudi Arabia is recording an expense which is overstated, and that is why the profit has gone down, and this company cleverly is not paying enough tax to us. That's the concern Zatka has, right? On the other hand, if you think about FTA will be like very, very happy. That is good. I mean, a lot of money. This UAE company is, even if it is overpricing, we don't care. More tax is coming to us, because by overpricing, they are booking higher amount of revenue in their books. So the profit in UAE companies' books is going high, so we are getting more tax. But under this, entire transfer pricing mechanism, or becoming member of the inclusive framework of the OECD, both countries, UAE and Saudi Arabia, have to act ethically. So the UAE will not take the position that, okay, let us keep happy and let's stick the company to booking this higher revenue because we're getting more tax. No, that's not how UAE will react. They will stay neutral. Zatka may go to that taxpayer and say that, we have reviewed your transactions and you are overbooking your expense, so you have to adjust your expenses. So, and Zatka may even come to FTA telling that, look, we have done the transfer pricing review, and we feel that our Saudi Arabian company was overbooking expense. So your taxpayer in UAE should also pass a corresponding adjustment in their books. So, interestingly, both companies will adjust their books. So, this is the power of transfer pricing. It can even happen at countries' revenue authority levels. Okay. Transfer pricing issues originally arose in the transaction between associated enterprise. This we discussed. Uh, If other jurisdiction does not agree to make corresponding adjustment, M&E group will be taxed twice on that part. So that's the concern. As I mentioned, it can happen at revenue authority level as well, and sometimes the entity may find, the UAE entity may find that, I mean, I'm not talking but per se about UAE, but take any country's example. Some country where the taxation system is not as fair as UAE, they may simply say no to Zatka, saying that no, from our point of view, our company in UAE is booking the right value of revenue. So this poor company, the group at a group level, they may have to incur some unfair amount of tax, because in Zatka they have to pay higher tax, and in the other country also they are paying higher tax. So that is double taxation of some part of the profit. So in that case, litigation will come in. The group will file a case on uh, in one of the jurisdictions. There will be a legal matter arising. Any questions up till now? None? Okay. So what we are going to look at now is the OECD guidelines on transfer pricing. Let us have a purpose of the guideline. The guidelines are intended to help tax administration of both OECD member countries and even non-member countries and multinational enterprises by indicating ways to find mutually satisfactory solutions to transfer pricing cases, thereby minimizing conflict among tax administration and between tax administration and the multinational enterprise, and avoiding costly litigation. That's what I said earlier, that because of this situation, that one revenue authority said no to adjust the books, uh, it can give rise to litigation, and that litigation will be very costly. So transfer pricing guidelines help the companies as well as the authorities to avoid litigation. The guidelines analyze the methods of evaluating whether the conditions of commercial and financial relations within the multinational enterprise satisfy the, this is the key word for us to remember. Whenever transfer pricing, you guys think about transfer pricing, there are two things that should always come to your mind. What are those two things? Number one, that I have highlighted, arm's length principle. There, all the transactions must be at fair market value between knowledgeable and willing buyers. That's arm's length, right? What is the other thing that should come to our mind? Transfer pricing will always happen between, can you complete the sentence?
Associate companies.
Associated enterprises. These two things should always come to our mind. That transfer pricing will always happen between associated enterprises. And the second thing is those transactions between associated enterprises must be at arm's length. If you remember these two things, you have learned transfer pricing. And discuss the practical application of those methods. They also include discussion of global formulary apportionment. So there is some formula, different methods are there, different formulas are there. How do we apportion the transactions or the profits? That's something that will be addressed and discussed under the transfer pricing rules and guidelines. Guidelines in domestic transfer. Now, we need, why this word domestic has come in? Can anybody give me an idea? If it is domestic, the other type should be what? International or cross border, right? But can there be domestic transfer pricing and then a different type international or cross border transfer pricing? Can somebody tell me?
Yes. So domestic means, like, let's say, uh, if the parent company is having transactions with the associated companies within the same country,
Hmm.
yeah, there can be, the transactions which are not based on arm's length, so there can be implications for that. And then for international, like, it's more of the considering the transferring the profits to the lower taxed jurisdictions. So this kind of implications are there in that matter.
Very good, very good. Absolutely correct answer. Transfer pricing can happen, transfer pricing issues or challenges may happen domestically and internationally. A large part of that happens internationally, which is much more significant. But it can have equally happen within the country itself as well. And Mujaddid rightly answered that it can happen within group companies. So multiple group companies are located within UAE and they have extensive interaction transactions. Those transactions naturally would be subject to arm's length principle even within the group. Why? Because of separate entity approach. Each when the entities have separate TRNs, that's when these entities will always be seen as separate entities. But there are other rules as well which require looking at this group as a multinational enterprise. But again, we will look at the definitions of that later. But in simpler words, group of companies, all of them incorporated in UAE, there can be transfer prices amongst the subsidiaries, and naturally transfer pricing rules and regulations would apply. They are encouraged to follow these guidelines in the domestic transfer pricing, and taxpayers are encouraged to follow these guidelines whether transfer pricing complies with the arm's length principle. Administrations are encouraged to take into account taxpayers' commercial judgment about the application of the arm's length principle in their examination practice and to undertake their analysis of transfer pricing from that perspective. Following the guidelines, these guidelines are also intended primarily to govern the resolution of transfer pricing cases in mutual agreement proceedings. So, if you recall, one of the areas of double tax agreements or the Model Tax Convention 2017 was the tax administration, mutual agreement procedures. Like there can be a disagreement between entities of two different countries, and two authorities may have to discuss a matter where there was an apparent disagreement and come to a mutual consensus. That is called mutual agreement procedures or proceedings between OECD member countries, and where appropriate arbitration proceedings. So sometimes this can also happen that both authorities could not reach an agreement, and they said, okay, let us resort to arbitration. So arbitration can also happen. They further provide guidance where a corresponding adjustment request has been made. The commentary on paragraph 2 of article 9 of the Model Tax Convention makes clear that the state or the country from which a corresponding adjustment is requested should comply with the request only if the state considers that the figure of adjusted profit correctly reflects what the profits would have been if the transaction had been at arm's length. So OECD is also cognizant of the fact that one revenue authority of a country may come to a wrong conclusion, and they may reach out to the other country's revenue authority and say, look, we have instructed our country's company to pass a transfer pricing adjustment in their books because in our view it does not align with arm's length principle. So you also do the same to the associated enterprise of this company incorporated in your country. So you also pass a corresponding adjustment. Now the other authority may be even more capable, knowledgeable, and expert on this matter, and their review reveals that the request made by the other country's revenue authority is not fair. They may decline it, and OECD Model Tax Convention allows it. Why? Because but it has to be based on, it has to be substantiated by facts and should be on grounds. So that's when the mutual agreement procedures will come into play, and even arbitration may come into play. This means that the competent authority proceedings, the state that has proposed the primary adjustment, bears the burden of demonstrating to the other state that the adjustment is justified both in principle and as regards the amount. So the calculations are also correct, and the underlying principle because of which an adjustment has been proposed is a valid principle. They have to demonstrate it. Who has to demonstrate this? That revenue authority which is proposing the adjustment. Both competent authorities are expected to take cooperative approach in resolving this matter. Allocation of the burden of proof. Okay. In seeking to achieve the balance between the interests of the taxpayer and the tax administration in a way that is fair to all parties, it is necessary to consider all aspects of the system that are relevant in transfer pricing case. So naturally all facts will be considered while looking at a transfer pricing case. One such aspect is the allocation of the burden of proof, like who has to prove some ground facts. In most jurisdictions, the tax administration bears the burden of proof, which may require the tax administration to make a prima facie showing that the taxpayer's pricing is inconsistent with the arm's length principle. So the burden of proof lies on the authority, revenue authority. That's the general principle. It should be noted, however, that even in such a case, a tax administration might still reasonably oblige the taxpayer to produce its records to enable the tax administration to undertake its examination of the controlled transactions. So yes, I mean, revenue authority will require cooperation from the taxpayer, right? Even if they want to prove some basic
Yes.
logistical information they are going to require, and those information have to be,
Mhm.
that information has to be provided by the taxpayer. You were saying something, Nazar?
No, no,
Okay. Okay. In other jurisdictions, the taxpayer may bear the burden of proof in some respects. So, like, it's a case to case basis, and it is all based on logic that who has to provide the burden of proof. But generally, it is there on the primary responsibility is falls on authority, because who is objecting here? It's not the taxpayer, it's the revenue authority that is objecting here. So, though that one who objects has to provide the proof of objection. So there are rules written on the burden of proof. So some OECD member countries are of the view that Article 9 of the Model Tax Convention establishes burden of proof rules in transfer pricing cases which override any contrary domestic provision. See, the course author has also mentioned this point that the international framework provided by OECD, it can override the domestic provision, domestic law. Other countries, however, consider that the Article 9 does not establish burden of proof rules. So there is a kind of a disagreement between countries on this. So Article 9, regardless of which party bears the burden of proof, an assessment of the fairness of the allocation of the burden of proof would have to be made in view of the other features of the jurisdiction's tax system that have a bearing on the overall administration of the transfer pricing rules, including resolution of disputes. So to summarize this, I mean, you can't, it's a granular level matter, and when this such a case arises, the high level burden of proof will lie on the revenue authority, but provision of information, etc., that will lie on the taxpayer. So now we are going to read this famous Article 9 of the OECD Model Tax Convention. OECD Model Tax Convention Article 9 is determined by the management and profit of the contracting state. Let us have a look at both. Where A, an enterprise of a contracting state, participates directly or indirectly in the management, control or capital of an enterprise in other contracting states. So we are talking about two countries and two companies that are incorporated in those two countries, or a company and a permanent establishment. How and one country's company controls or participates in the management of the enterprise in the other country. That's an example of associated enterprise. Or the second category, the same person participates directly or indirectly in the management, control or capital of an enterprise of a contracting state, an enterprise of the other contracting state. So two enterprises are set up in two countries and the shareholder is common. Both scenarios make those two enterprises as associated enterprises, and in either case conditions are made or imposed between the two enterprises in their commercial or financial relations which differ from those which would be made between independent enterprises. So they are transacting in a manner which is not in line with the open market. So they are controlling, the transactions are controlled transactions. Then any profits which would, but for those conditions, have accrued to one of the enterprises, but by reason of those conditions have not so accrued, may be included in the profits of that enterprise. So wherever unfair allocation of profit has been made, it will be reversed and transferred back to the other enterprise. In short, second point was on profits, where a contracting state includes in the profits of an enterprise of that state and taxes accordingly profits on which an enterprise of the other contracting state has been charged to tax in that other. Second, guys. Right, let me read it again. Where a contracting state includes in the profits of an enterprise of that state and taxes accordingly profits on which an enterprise of the other contracting state has been charged to tax in that other state, and the profits so included are profits which would have been accrued to the enterprise of the first mentioned state, meaning unfair allocation of profit. Uh, uh, so what will happen? Then the other state shall make an appropriate adjustment to the amount of the tax charged. So double taxation. Basically, there was an unfair allocation of profit. So the suffering state can propose that, make a transfer pricing adjustment. This is that Article 9, which not only defines associated enterprises but also addresses what will happen if there is an unfair allocation of profit. Article 9 applies in circumstances of the pricing in a commercial relationship between associated persons or enterprises being different from a true commercial price due to undue circumstances or influences. So, OECD commentary on Article 9 confirms that an adjustment is not automatically to be made in state B simply because the profits in state A have been increased. So, this is not an automatic thing. We have to see the fairness. The adjustment is due only if the state B considers that the figure of adjusted profits correctly reflects what the profits would have been uh, if the transactions had been on arm's length. So, I'm going to go to the next thing because this is kind of repeat. Now we are talking about associated enterprise. Two enterprises are associated enterprises. I think you've understood it. So I will, instead of reading it, I'm going to ask you to repeat your understanding, which we have read 2-3 times by now. What are two associated enterprises? Can somebody give this answer? What is meant by associated enterprises?
Related parties.
Related parties. So how will one enterprise be a related party or associated enterprise of the other company?
By controlling.
By controlling. Directly controlling. So two companies are there, one company controls the other company, they are associated enterprises, correct? Mr. Nausar?
Yes.
Yes?
Yes.
Yes.
What about a third shareholder, Mr. Nausar? There is a second scenario as well. You remember?
Yes. Third is minority shareholder.
No, majority shareholder. So if there is another shareholder who controls both enterprises, so this is a triangle. One shareholder controls both the enterprises, right? So you have two companies, you are owning both of the companies. Then those two companies will be known as what? Related parties or associated enterprise. Okay. So this is the concept of associated enterprise. To go to the next part. OECD methods. This is a very important topic. OECD has established two main categories of transfer pricing methods, with the first traditional transaction containing three subcategories and the second transactional profit method having two subcategories. This you need to remember and understand. There are two methods. One is the traditional method, and the second is a kind of a reverse method called transactional profit method. The traditional transaction methods are comparable uncontrolled price method or CUP method. Famous name, CUP. Comparable uncontrolled price. The resale price method and cost plus method. So these are traditional transaction methods. The transactional profit methods are the transactional net margin method, TNMM. Transactional net. So we, instead of looking at the individual items, we look at the bottom line profitability, and the transactional profit split methods. These are transactional profit methods. So traditional transaction method. Let us have an overview of this. CUP method. Famous comparable uncontrolled prices. Let's have a look at it. This method compares the price charged for property or services transferred in a controlled transaction to the price charged for the same property or services transferred in a comparable uncontrolled transaction. When we say comparable but uncontrolled, we are talking about open market transactions. You cannot control your supplier, right? Comparable uncontrolled transaction in a in comparable circumstances. So that's the CUP method. If there is any difference between the two prices, this may indicate that the condition of the commercial and financial relations of the associated enterprises are not arm's length. So you were purchasing anything from a third party vendor, that vendor will charge you a certain price which reflects open market price. but then the same thing you were going to purchase from one of your group companies. If that group company does not charge you the same or similar price, then that means there is some undue influence that has been exercised. So arm's length principle was not complied, and that the price in the uncontrolled transaction may need to be substituted for the price in the controlled transaction. So we are getting an example. A company sells cocoa of a similar type, quality and quantity as those sold between two associated enterprises. The controlled and uncontrolled transactions occur at about the same time and under similar conditions, but the cocoa for the uncontrolled transactions comes from country A and the controlled transaction from country B. The source of the cocoa is different. If the only available uncontrolled transaction involved cocoa was from country A, it would be appropriate to inquire whether the difference has a material effect on the prices. So we'll have to look at the prices of cocoa in both countries and see whether there's a difference. For example, whether the country A cocoa commands a premium or requires a discount. So transfer pricing is a very open-ended area, and naturally because business has unlimited aspects, we will have to look for reasons of a differing price, and we have to make a judgment call whether this reason is just justifiable and fair or not. So it is quite possible that the country A from which the associated enterprise is purchasing cocoa, that has a much higher quality, and because of which the price is higher. So these factors will need to be considered under transfer pricing. Resale price method. The resale price method begins with the price at which a product that has been purchased from an associated enterprise is resold to an independent enterprise. So reselling to an independent, this price, the resale price, is then reduced by an appropriate gross margin on the price, the resale price margin. So you buy something and then you sell it to another, it's a trading business, very good example of trading business. Some company in UAE is purchasing goods from China and then selling it in the open market, right? The interesting part is that the Chinese company is an associated enterprise, right? And what happens is that the company in UAE, which is the trader, they are selling it to independent third parties as well. So what will happen? That independent third party sales will be benchmarked for a gross margin, and then that will give us an idea of whether the purchase price that we paid to our Chinese company, our group's Chinese company, associated enterprise, was that a fair selling price or not? So so reverse calculation basically it will happen. That is the price resale method. I think in the next we will have an example itself. A company sells books through independent distributor in the book wholesaler 4 countries. The distributors market the book and do not conduct value added functionality. So no value addition is made, simply purchase the book and sell it. In the 5th country, a subsidiary is organized. Since that market is strategically important, the distribution contract limits the subsidiary to selling group books and to assist the later wholesaler chains in setting out the book sales areas. If the margins are derived from independent enterprises without exclusively sales arrangement or performing added value functionality, it is necessary to consider whether adjustments are required for comparability. In simpler words, as I said earlier, this is a three-party relationship where the last party purchasing goods or services is independent third party. We will do a benchmarking exercise that usually when you are selling goods or services to a third party, usually how much gross margin would you charge, and then we reverse calculate the prices. That's the resale method, price resale method. So we are now looking at cost plus method, another of the traditional methods. Cost plus method begins with costs incurred by the supplier of property or services in a controlled transaction for a property transferred or services provided to an associated purchaser. Uh, we might know that particularly in India, there are, so many back offices established from around the world. For example, in the Big Four, Deloitte, EY, they have very large back offices called GDA, Global Delivery something services, or Techno Hub, etc. Those are not direct revenue earning enterprises. They provide back office services to these regional practices. So if they are not really earning revenue, their entire revenue is actually internal. That's where cost plus will come in. What is arrived at after adding the cost plus markup to the above cost may be regarded as an arm's length price of the original controlled transaction. This method probably is most useful where semi-finished goods are sold between associated parties, where associated parties have concluded joint facility agreements or long-term buy and supply arrangements, or where the control transaction is the provision of services. So there is an example that has been cited. A multinational enterprise group has company A and company B as subsidiaries. So two subsidiaries of the M&E. Company A undertakes all product research for company B. So, but all risks related to the research are assumed by company B. So company B has commissioned the research basically, and who's doing it? Company A. Because the intangibles are owned by company B, the risks that are being assumed are from the company B who has commissioned the research. Company B is entitled to a profit from owning the intangibles. The expenditure incurred on the research which the associated parties have agreed upon is to be compensated, and the margin over the cost should allow for the company of the company for should allow for the complexity of the research. So there, that the company A who is actually doing the very ground level work for the research, they will have the facility to charge a markup on the costs that are incurred. That's cost plus. Now we're coming to the second category, which is actually the dominant category. Subcategories of the transactional profits method. In UAE, actually, majority of companies are performing this approach, transactional net margin method. Why? One of the reasons is lack of availability of comparable information. The transactional net margin method examines the net profit relative to an appropriate base, for example, cost, sales, assets, that a taxpayer realizes from a controlled transaction. Thus, a transactional net margin method operates in a manner similar to the cost plus and resale price methods. So basically, what we do is we don't have enough information. We say that okay, if under this particular profit and loss account of an associated enterprise, if the bottom line profitability is reasonable in contrast to the revenue, then or as a return on investment, then we will accept everything that is there in the profit and loss account, a kind of a high level approach. This similarity means that in order to be applied reliably, the transactional net margin method must be applied in a manner consistent with the manner in which the resale price or cost plus method is applied. So what were we doing in resale price? In case of resale price, we were buying some things and then selling it to third parties, and then we were doing a reverse calculation. And under the cost plus method, it was slightly different. Cost plus methods were being applied to long lived relationships whereby one entity was performing either services or selling semi-finished goods, and they were allowed to put a markup on that. These were the two methods. In the same manner, the transactional net margin method will also be applicable, but from the bottom line profitability. So we will allow for a bottom line. We'll say that okay, benchmark profit for this particular industry for a company of this big size is this much. This is the benchmark, and then we look at the reverse calculation. This means that the net profit indicator of the taxpayer, net profit indicator, this is the keyword here, of the taxpayer from the controlled transaction should ideally be established by reference to the net profit indicator that the same taxpayer earns in comparable uncontrolled transactions by reference to internal comparables. This multinational enterprise has multiple companies naturally, so you can even look at internal comparables as well. So in multiple countries there will be companies earning profits, so there cannot be a huge deviation, standard deviation between the net profits of different countries. Yes, because of economic circumstances there would be deviation, but there has to be some rationale to uh, allow for the deviation. Where this is not possible, the net margin that would have been earned in comparable transactions by an independent enterprise. Now we are talking about external comparables. So if it is a group and has multiple subsidiaries, you can set up internal comparables because this is easier to calculate. But if this internal comparable information is simply not available or not reliable, then we have to resort to external comparables, which may serve as a guide. A functional analysis of the controlled and uncontrolled transactions is required to determine whether the transactions are comparable and what adjustment may be required. So functional analysis is a broad area whereby what we do, we look at what exactly are the actions being taken or responsibilities being assumed by a particular associated enterprise. Functional is one of the three main criteria. If you remember in our previous discussions, I have used a word called FAR analysis. Can somebody remember what was FAR analysis? Mujaddid? Abbas?
It's to analyze the underlying asset or the risk associated with the if it's related to the related party. So we need to analyze the assets, the risk associated with it, and the functionality.
What is the output of FAR? FAR is an abbreviation. FAR. FAR stands for functions
Function,
as
asset, risk.
risk. Exactly. So when we do these comparability analysis, we have to look at least these three. Some include substance as well, but at least these three are very, very important. Functions we have to analyze, that's called a functional analysis. Then we have to look at the asset base of the enterprise, and then we have to look at what type of risks that enterprise is assuming. That's FAR analysis. Further, other requirements for comparability must be applied. There is an example. Consider the cost plus example on group research. Here, it is accepted that an adjustment is required, but it is not possible to identify the particular cost for which an adjustment is required. So the company that was performing research, company A, uh, we are not able to identify which cost to consider in that. However, it may be possible to identify the net profit from the transaction and allocate it between two parties using a consistent basis. What was that? It was a research that was being performed for an intangible asset that was owned by company B, and who was performing the research, company A. So what we are saying is that because of the research, if there is a profit that is earned, there may be a basis to allocate that profit profit between the two companies, company A and company B. For example, if the supervisory, general and administrative costs that are treated as part of the cost of the goods sold are not known, for example, if the supervisory, general and administrative costs that are treated as part of the cost of goods sold are not known, the allocation may be made using the net profit indicators. So, we might have to look at the comparable similar companies who are providing the research services, and we might want to look at the profit indicators. What amount of profit are those companies earning? And that would become our net profit indicator. Now, transactional profit split method. So, we're now talking about how do we split profits. Let's have a look at it. The method first identifies the profits to be split from controlled transaction, the relevant profit, and then splits them between the associated enterprises on an economically valid basis. So, we will find an economically valid basis that approximates the division of profits that would have been agreed at arm's length. So, based on an economically valid basis, we will have to split the profits. The transactional profit split method is particularly useful when the compensation to the associated enterprises can be more reliably valued by reference to the relative shares of their contributions to the profits arising in relation to the transactions than by a more direct estimation of the value of those contributions. So, as I said earlier, here the FAR analysis will come into play, like in that particular research transaction which company B had commissioned, and the back office company A was actually conducting the ground level research. We had discussed that all the risks were assumed by company B. Some administrative support may also be provided by company B. So at least two of the indicators we can see, the functions and the risks. Now, the company A, which was actually conducting the research, had deployed assets into that research, or performing the research. So that means the team was also deployed. So functions was also there, but risks it was not assuming. So here we can estimate the weightage of these functions, assets and risk, and based on that this will provide us a valid economic basis to split the profit between company A and company B, which have accrued as a result of that research. How to choose the right method? Transfer pricing methods chosen must be the one which is the most appropriate method for a particular case. In choosing the most appropriate method, the respective strengths and weaknesses of the OECD recognized methods must be allowed. So, we have to look at appropriateness of the method. Also to be reckoned with is the appropriateness of the method considered in the light of the controlled transaction, having reviewed a functional analysis and taking account of the reliable information. So, naturally the same thing, we have to look at the functions and gather the relevant information, in particular on uncontrolled comparables, because uncontrolled means independent, open market. It is also necessary to identify the comparability between controlled and uncontrolled transactions, including how accurate the comparability adjustments are. So, once we have gathered data, comparable data for controlled and uncontrolled transactions, we can arrive at better conclusions, informed conclusions. Use of more than one method. The arm's length principle does not require more than one method for a given transaction, and in fact, undue reliance on such an approach could create a significant burden for taxpayers. So, naturally, I mean, the idea is not to burden the taxpayer. So, transfer pricing guidelines recommend that one of the methods, the most appropriate one, given the circumstances, should be applied. For this reason, the TP guidelines do not require either the tax authority or the MNE to analyze the pricing under more than one method. While in some cases the selection of a method may not be straightforward and more than one method may be initially considered, generally it will be possible to select one method that is apt to provide the best estimation of the transaction. However, for difficult cases where no one approach is conclusive, a flexible approach would allow the evidence of various methods to be used in conjunction. It depends on the case, to be quite honest. If there is a complex scenario, we may have to resort to more than one method, but transfer pricing guidelines do not require multiple methods being applied. A multinational enterprise is not required to fully compute a transfer price under more than one method. While primary calculation under more than one method may prove useful, especially in difficult cases, the tax authority does not expect the multinational enterprise to fully calculate a price by using more than one method. Initial level working can happen. So we can consider, high level conclusions we can or findings when we apply more than one method. If the results are similar and we can see that the approach that we are taking is giving us the right results, then one of the those multiple methods we can deploy end to end or in its entirety, and the other method we would use only at an initial stage to ascertain whether we are in the right direction. What the hell is happening? Okay, OECD has confirmed that the three main objectives confirmed by OECD are two. Now, this is a policy level, objective. Ensure taxpayers fully consider the transfer pricing consequences when establishing prices in associated enterprise transactions, and also for how those transactions are to be reported in tax returns. So that's the first policy objectives, that taxpayers should understand that what will be the impact of choosing an incorrect transfer pricing approach, and naturally how their tax returns will be affected if they have not complied with rationality while choosing the transfer prices. Inform the tax administration of all relevant information when conducting an inquiry. So what is this inquiry that we are talking about? Usually, the tax laws in countries allow a taxpayer to go to the tax authority and sometimes seek advice or advanced pricing agreement, or seek clarification that, look, we are about to apply these prices. In your view, are these prices appropriate? So that's the inquiry. So tax administration, enough information should be provided from the taxpayer. Providing the tax auditor with useful information when reviewing the transfer pricing practices of entities subject to tax. But if there is a tax audit open, naturally they will question a lot of information, they will seek a lot of information, so right information has to be provided. Although it may be necessary to supplement the documentation with additional information as the audit progresses. So if the taxpayers understand transfer pricing, they will know what the tax auditor is seeking, and they'll be able to drive the information flow appropriately and efficiently. So since we are talking or discussing documentation, master file and local file, these are the types of transfer pricing documentation that comes into play. In order to assist both the multinational enterprise and the tax auditor in the preparation and examining the related party transaction, a master file must be prepared. That's the high level file. This file is intended to provide an overview of the M&E Group business, including the nature of its global business operations, its overall transfer pricing policies, and its global allocation of income and economic activity. So, master file is a high level document, and it addresses the overall business of the multinational enterprise. Using this information, the tax administration can identify the existence of any significant transfer pricing risk. The master file contains a high-level overview of multinational enterprises' transfer pricing practices, scaled by reference to global economic, legal, financial, and tax context. So, naturally, I mean, a company is already present in, let's say, 50 countries, and in one country, the presence is very, very minimal. So, naturally, when the tax authorities uh, look at that particular country's operations, they will know that the overall size of the operation in context of the global operation is so minimal that a lot of transfer pricing risk does not exist here. So that they will find out by having a look at the master file. Uh, Context, while not requiring a complete listing of the assets, liabilities, functions, as it will be unnecessarily time consuming. Taxpayers should use prudent business judgment when deciding on the level of details to be included in the master file. Local file. So that's a granular level file. It provides more information. This file provides more detailed information on the intercompany transactions and supplements the master file and encourages compliance with the arm's length principle in specific jurisdictions. The local file lists information pertinent to the transfer pricing analysis of the actual associated party transactions, which are material in the context of the jurisdiction's tax system. Information to be included would be the financial information regarding those specific transactions, a comparability analysis. So basically, granular level detail, the transactional level detail, and whether they are comparable transactions, and what pricing comparability information is available. A selection and application of the most appropriate transfer pricing method. What method did we apply? So these are all the contents of the local file. If a requirement of a local file can be fulfilled by information included in the master file, then a cross reference is acceptable. Interestingly, that can also happen that the some information uh, is already provided in a master file that would be required in a local file as well. So we can give the cross reference to the master file. Properly and thoroughly prepared master and local files should minimize compliance implications should a tax authority choose to audit the associated person's transactions. Now, two types we read, master file and local file. A third transfer pricing documentation is called country by country report, which UAE had adopted some time ago. So, the CBCR or country by country report requires aggregate tax jurisdiction wide information covering the global allocation of the income, taxes paid, and indicators of the location of economic activity among tax jurisdiction in which the multinational entity group operates. So each country basically may have a slightly different format, but generally speaking, the information provided by country report that will be integrated at the head office level for the multinational enterprise, and like from a UAE perspective, it will contain UAE related information and it will be filed, and copy will be there. So as the name suggests, country by country reporting. So this report will be generated in all the countries where that multinational enterprise exists. The report requires the constituent entities to be listed for which financial information is reported. So you can see that the constituent entities is written in title case. First alphabets are capital. That means it has a specific meaning. We will come to that. Including the tax jurisdiction of incorporation were different from tax jurisdiction of residence. So it very interestingly, uh, where a company is incorporated and where a company is resident, tax resident, sometimes it may differ as well. I think you guys some of you, except for Mr. Nozer who has joined today, some of you would be able to tell that what are those circumstances in which country of incorporation may not be the same as the country of tax residence. What is that? Can somebody answer in one word?
Permanent establishment, foreign
No,
permanent
no,
establishment.
no, no, wrong.
Place of effective management.
Yes, poem, place of effective management. There can be a situation where a company is incorporated in Qatar, for example, and the shareholders of that company are living in UAE, right? So that company which is incorporated in Qatar could be a tax resident of UAE. Why? Because all the strategic decisions are being taken in UAE. The shareholders, the controllers are living in UAE. This company is actually being controlled from UAE. Place of effective management of that Qatari company is UAE. That Qatari company will be seen as a tax resident of UAE, and that company will be subject to registration with the Federal Tax Authority in UAE. Mr. Nazar, did you know that?
No, no,
So this is called
no.
place of effective management.
Okay.
Okay. Only
Okay.
only M&E groups having turnover in excess of 750 million euros in the preceding year are required to file the country by country report. By the way, uh, why is this 750 million euros figure important in the context of transfer pricing? Can somebody answer?
Uh, I mean, it's a threshold for the compliance of the transfer pricing. What you call it? The legalities. Like each company does not have to, make all this kind of workings for the transfer pricing when their revenue is very small.
Okay, Kalima, why is it important, this 750 million euro figure?
In UAE or like overall? I think
Okay,
it's
huh,
the
Pillar
top
two.
up
It's
tax
it's
would.
for the pillar two.
exactly, pillar two. So, bhai, the
Yes, yes.
simple answer is that under the BEPS pillar two mechanism, the word MNE, multinational enterprise, is defined by this figure, 750 million euros. So, if a group has multiple country presence and the global consolidated revenue is at least 750 million euros, only then that group will be called or considered a multinational enterprise and will be subject to certain requirements, for example, country by country reporting. Okay, so that's something for us to remember. BEPS pillar 2 will apply to that group, and if that group has reached 750 million euros turnover at a global level, what exposure will it have other than the documentation or filing country by country reporting? From a UA perspective, can somebody answer that?
Sorry, can you repeat, please?
My question: if a group becomes a multinational enterprise group in the context of BEPS Pillar 2, what exposure will it have from a UA perspective?
Um, they have to consider the top up tax
Very
to
good.
be minimum at 15%.
Very good. Their tax rate will change. Mr. Nozer, since this is your first
Yes.
day, you should understand if a global, I have a client, okay? I'm not going to tell which client is it, but I'm just telling you. I have a client which only earns very small level of dividend income in UAE. Okay, very small, maybe not even, I don't know, maybe 1 million dirham or 2 million dirhams or something, a small group. Okay. And they reached out to me that's, Mr. Altaf, can you please provide us corporate tax services? But I became aware that this is part of another group which has presence in UK, presence in Pakistan, presence in other countries. It is listed in some other countries as well. And I became aware that this company's global turnover exceeds 750 million euros. So, in my engagement letter itself, I had to include the consideration of the top-up tax regime, the consideration of BEPS Pillar 2 framework, and suddenly the fees of that engagement went sky high. So this is a trap as well for practitioners, that you might find some multinational company which has a very small office in UAE, and they will come to you, can you please, it's a very small company, we have hardly earned maybe 1 million dirhams of revenue during there, can you please do our impact assessment or file our corporate tax return? And that will be a trap for you. And why do I say that? Because unless you know that this very small tip of the iceberg in UAE is actually part of a multinational enterprise, M&E group. Actually, what you are about to ignore was the top-up tax regime that would apply to it. And then suddenly that group will be subject to so many different compliances that you will have to look at the master file review, you will have to look at the local file review, you will have to ensure that this group is compliant with the CBCR reporting regulations, etc., etc., etc. So please understand this point very well. The report is intended to help in high-level transfer pricing risk assessment purposes and for use by tax administration when evaluating other BEPS-related risks. Okay, this point should be clear to you guys. This 750 million euros and M&E group, it changes your entire outlook of a company, even if apparently the company in the UAE or in Qatar or other it's a very small. Qatar has recently implemented, am I right, Mr. Nozar? You're aware
Yes, yes,
Qatar has implemented the BEPS Pillar 2 framework.
yes.
Top-up tax regime has come. The report is intended to help high-level transfer pricing risk assessment purposes and for use by tax administrations when evaluating under BEPS-related risk. Economic and statistical analysis may also benefit from the information, but the report should not be a substitute for a detailed transfer pricing analysis of the associated party transactions, including a full functional and comparability analysis. So there is a lot of work that needs to be done on multinational enterprises. Country by country reports serve as a useful background and source of information for the tax authority while not providing information which can be directly used in a transfer pricing audit. So CBCR, yes, I mean it provides information, but it provides only so much information. So that's more details will be found in the local file and naturally master file if a tax audit opens up. Contemporaneous documents. So the taxpayers in a multinational enterprise group should endeavor to establish the arm's length price for the transactions at the time of the transaction, not sometime after the transaction has been made. So contemporaneous means at the same time or completed. So as soon as the transaction does, it is wise to update your local file. Doing so facilitates the taxpayers' financial accounts and tax returns. So you don't wait until the end of the year, otherwise you may be in trouble because you might not find, there will be a limitation on scope. You will not be able to find comparable data at the year end. As soon as transactions happen, you should become aware that we have to ensure that we obtain evidence of comparability analysis immediately. Preparing the documentation contemporaneously also is intended to manage what may otherwise be disproportionately high cost and burden in producing the documentation. So that's a very important point that they have raised, that if you delay it and wait for the year end and all that, then later on you might have to even pay for getting that information which you could have gotten easily at the time of those transactions, comparability information, market research. So that is why it is advisable that for such enterprises, MNEs, or even if it is not an MNE but the transfer pricing compliance applies to it, in UAE it does. Maybe some of you, very few of you might know that even if a group is not a multinational enterprise in UAE, sometimes the transfer pricing documentation requirement applies to it. Anybody knows that?
Yeah, if for example, if your transactions with the related party is around 4 million, or if the similar type of transactions, I mean, there are some thresholds. If you meet that, even if a related party,
Even if you are a local group in UAE, you're not a
yeah,
multinational enterprise, but even if you're a local group and your revenue exceeds 200 million dirhams per annum, then
yeah,
transfer pricing documentation applies to you in UAE.
yeah,
UAE rules. In this section, you will review the fabric of the UAE's international transfer pricing rules with an emphasis on the transfer pricing provisions included in the Federal Decree Law number 47 of 2022, otherwise known as the UAE Corporate Tax Decree Law. The first term to be understood in making headway with the decree law is related, because payments between related parties must be tested for arm's length. So which article addresses it? Article 35 defines related parties and OECD's comparable term, associated enterprises, in the following manner. So very interesting angle, especially written from a UAE perspective, but actually if you really look at it, the model tax convention also uses similar definition. Two or more natural persons who are related within the fourth degree of kinship. What does that mean? Fourth degree of kinship. So two natural persons. Let's say Mr. A, then his father, that's the first level of kinship. Then the grandfather, that's the second level. Then great grandfather is the third level, and then great great grandfather, that's the fourth level of kinship. So if someone has a great great grandfather common, then those two people will be seen as related parties, or kinship or affiliation included by way of adoption or guardianship. So these two natural persons will be considered as related parties. The degree of kinship are parent to a child, first degree, grandchild, nephew, niece, first cousins, fourth degree of kinship. So all of this is covered. This is a more detailed level of association than the OECD applies. For example, a father and a son are related by first kinship, grandfather is related by second kinship to his granddaughter, and uncle is related by third kinship to his niece, and the son of a man is related by fourth kinship to the daughter of that of the man's sister. So I think you guys understand the complication. A fourth degree of kinship applies. A natural person and a juridical person. Now, previous provision, not example, provision was between two natural persons. Related parties can be one natural person and a company also, a legal person. A natural person and a juridical person, a non-human legal person, that is not a single natural person but an organization recognized by law. That's the meaning of juridical person, where the natural person or one or more related parties of the natural person are shareholders in that juridical person, and the natural person along with those related parties directly or indirectly own a 50% or great ownership interest in the juridical person. So for example, one man and his wife own 50% in a company, but the man holds only 25, wife holds 25. then do you think that man and his wife will be seen as related parties of that company? Yes, they will be. Why? Because together they own 50% and they are both, related parties themselves. A natural person alone or together with its related parties directly or indirectly controls that person. Natural person alone or together with the related party controls it. Here it was ownership, 50% shareholdership or ownership, legal ownership. What about control? It can also happen. A person, there can even be a UBO relationship, ultimate beneficial owner relationship. For example, I want to own a company, but I don't want to directly own it. Like what I do is I will take my driver, for example, and make him a shareholder in my company, and I will sign an agreement with my driver that look, you are not going to exercise any control on this company. You will not even breathe with respect to this company without my permission or say so. So what did I create just now? Who's the ultimate beneficial owner of this company? I am. My driver, whom I placed as the shareholder of the company, the poor guy cannot do anything with that company. Why? Because I have a legally enforceable contract in place. So this is an ultimate beneficial ownership arrangement. Who controls it? The driver or me? I control it indirectly. So control rests with me, although I am not the legal owner of the company. So that's the concept of control. For example, a father and the company in which the father owns not less than 50% of the shares, the daughter and the father own not less than 50% of the shares, the niece of the father who owns not less than 50%. So the various examples can be there. So that was an example of a natural person and a legal person. Now we're coming to the third category. Two categories we discussed, meaning two natural persons. Second category, one natural, one legal person. Third, two legal persons. Both are companies in this scenario. Two or more juridical persons can be related parties, where one juridical person alone or together with its related parties. Very interesting point. Related parties. Now the related party can be a human being or it can be a legal person, a company. Directly or indirectly owns a 50% or greater ownership interest in the other juridical person. So again, the key point is 50% ownership or control. One juridical person alone or together with the related parties controls the other person, or any person alone or together with its related parties directly or indirectly owns a 50% or greater ownership interest in or controls such two or more juridical persons. So, uh, actually there is another article in the decree law that even defines what is meant by control. So, we will look at that as well. But before we go there, we should look at the concept of permanent establishment as well. Now, one of the easiest, just for remembering memory hook purposes, somebody may forget what is the meaning of permanent establishment, but whenever you are about to forget that, remember one word, branch. That's because that is the biggest form of permanent establishment around the world. What is the point with the branch? Uh, a branch is not a, from a corporate law. I'm not talking about corporate tax law. I'm talking about corporate law. From a corporate law perspective, branch does not have a legal personality of its own. Why? Because that branch is actually an extension of the head office. The company that is incorporated either in the same country or another country that has opened that branch is actually an extension of that original company, head office company or a controlling company. So what happens between a person, when we say person, it can be a legal person, it can be a natural person as well, who opens a branch. So that branch, from the tax perspective, if you remember the separate entity concept, what we do is, from a tax perspective, we look at the branch as a separate entity, especially if it is a cross-border branch, because then the other country's tax laws apply. if that branch is set up within UAE and the parent company is also set up within the UAE, then there are chances that we will not create a distinction. There is a high likelihood that we will not create a distinction between that branch and the parent company, except in very exceptional circumstances, especially in case of a qualifying free zone person. Why? Because a qualifying free zone person may be in a it may be set up in a designated zone or a free zone, and it may have a branch in the mainland. That's the only exception in which case this branch will be taxed separately. That's those provisions we may come at a later stage, but for now please remember there's only one exception to this. Otherwise, branch or a permanent establishment is seen as an extension of the original company. A person and its permanent establishment uh, or foreign permanent establishment. Again, foreign permanent establishment is a branch or business presence which is in another country outside UAE. Uh, long definition. So anyways, three categories they mentioned. A person can have a permanent establishment or a foreign permanent establishment, and in that case they will be seen as related parties. Person and permanent establishment will be seen as related parties. So any transaction between the original company and its branch, what will happen? They will be subject to transfer pricing regulations, transfer pricing compliances, arm's length principle, and this becomes even more important if they are being taxed separately. So what are those circumstances in which they will be taxed separately? I just quoted. If it is a foreign permanent establishment, meaning your company is in UAE, branch is in Oman or Saudi Arabia, that's an example of a foreign permanent establishment. Or your company is in a free zone and your branch is in mainland, then their taxation will be entirely different. So in that case, these will be seen as related parties, and transactions between them must be at arm's length. One example has been provided. Is there any question, because these were very important concepts? Any questions up till now? Okay, apparently there is no question. So for example, a UAE resident and the office established in his name located in a foreign territory, a UAE juridical person and a foreign oil field company. So some examples have been provided. Another very important aspect, partners in the same unincorporated partnership. Can you guys remember what was meant by unincorporated partnership? Can somebody tell me? Okay, let me create a scenario and then ask you guys as practitioners. Okay, so you are in UAE, okay, and set up a business relationship with a partner, and you opened up a general partnership firm with Dubai Economy. You got a trade license, okay. So my question is, Haya has joined. Welcome, Haya. So my question is, this general partnership, the trade license that you have gotten, will this be seen as an incorporated partnership or unincorporated partnership? Who can answer this? This general partnership trade license that we have. Now I'm asking this as practitioners. I'm thinking of you as practitioners. You are in the field and a general partnership trade license has come to you. What are you going to treat it as? An incorporated partnership or unincorporated partnership?
It's
Farjad?
uh,
Uh,
it's unincorporated because the partners are separately and solely liable for their tax liabilities.
This was an interesting question and I asked this on purpose. Anybody else? Kalma, Haya, anybody else? Mujaddid, sorry, Farjad, Abbas, you're silent. So guys, yeah, anybody answering? Okay. There is a guide that was issued by Federal Tax Authority, and this question of mine was intended to identify a divergence of corporate tax law, UAE corporate tax law, from the corporate law of UAE. A general partnership, unless in the memorandum, if you look at the memorandum, usually sometimes it is written as general partnership company. Okay. Even if the liabilities of the partners are unlimited, a guide was issued by Federal Tax Authority telling that this general partnership trade licenses will be treated as incorporated partnerships. Guys, this is a divergence from the corporate law of UAE. Okay. So in other words, unincorporated partnership will be a simple trust partnership deed signed on a piece of paper between you and me. Got it? So otherwise, if you have a trade license for the partnership, it will be treated as an incorporated partnership. Okay. Now, an easier question, let me ask you. What about a limited liability partnership? Is that an unincorporated partnership or an incorporated one?
Incorporated.
That's an easier one. It's an incorporated partnership. Anyways, two or more persons that are partners in the same unincorporated partnership, they will be treated as what? Related parties. Please remember. Okay. Did we already study about unincorporated partnerships previously? I think we have. So can somebody tell me what is the default tax treatment for unincorporated partnership? Let's see if you guys can remember this. So somebody said that I have a partnership with this person and there is a partnership deed we signed on a piece of paper, but we haven't gotten a trade license for a general partnership. So this is an unincorporated partnership. We want to get ourselves taxed. They don't know tax law, they came to you. So what will be your answer to them? That this this partnership deed, an unincorporated partnership, what will be the taxability of this under the UAE corporate tax law?
They will be taxed at the individual partner level.
Very good. Correct answer. So unincorporated partnership, the default treatment is that the income will be taxed in the hands of the partners, not at the entity level. This is the default treatment. Okay. Now, other than Abbas, anyone can answer me. There is an exception to this rule. What is that rule? What is that provision? Come on, Farjad, you are very sharp, mashallah. Give me the answer. Or Haya, you are there. You guys are, mashallah. Can you guys give me an answer? Like there is an exceptional treatment for unincorporated partnership. So by making an application to the Federal Tax Authority that please treat us as single fiscal unit, an unincorporated partnership can be taxed at entity level, but that will happen only by way of an application. Okay, so that is the exceptional treatment. Okay, so anyways, for example, two natural persons who are partners in a joint liability company formed at the Dubai Department of Economy and Tourism, if there are natural persons, they will be, they will be treated as related party. Now, trust or foundation. Let me ask this question: what is the difference between a trust and a foundation? Can somebody tell me?
Foundation is a legal person, a legal juridical person, as trust
Very
is
good.
not.
Trust is not. But Abbas, just to add to your knowledge, uh, there are trusts in UAE, even under the mainland UAE, that I have read actually their constitution documents, that those trusts have also been given the legal personality. So addition to your information, please note this point down, that at the outset we will treat trusts as an unincorporated person or a non-juridical person, but there may be exception, and we have to refer to the memorandum of association of that trust. And sometimes you will find that, especially under the mainland also, which is a very unheard of thing, but you can see that some trusts even in mainland have been given a juridical personality. Okay.
Okay.
So we need to be aware of that. Anyways, for example, a natural person. So the point was that if there is a trust, what is the composition of a trust? Usually what happens is there are trustees in the trust, right? They are similar to partners or shareholders, and they are holding property or other investments or assets on behalf of some beneficiaries, right? So those trustees will be seen as related parties. That's the purpose of writing this here. And foundation, that's something which is trust plus a legal personality. So foundation is like a company itself. So by default, foundation structure will be an incorporated person. So members of the foundation, uh, they will also be treated as related parties. This is the topic we were addressing. In adopting this level of detail, it is evident that UAE wants to ensure tax deductible payments are not made to a wide range of connected or related parties for families with many members, where the amounts of each payment and the work don't align. Yeah, so arm's length. So we will see further connected persons as well. Yeah, so Article 35(2) defines control as the ability of a person, whether in their own right or by agreement or otherwise, to influence another person, including, again, that 50% rule will come in, the ability to exercise 50% or more of the voting rights. That's obviously, this is control, right, of another person. Ability to determine the composition of 50% or more of the board of directors, 50% or receive, or ability to receive 50% or more of the profits, and the ability to determine or exercise significant influence over the conduct of the business and affairs of another person. These are all manifestations of control. One example has been given: a natural person
Sorry.
own. Yeah.
Over here it said person everywhere. So that would mean natural as well, juridical person?
Yes,
Just juridical person.
wherever the word person is written, that will by default include both natural or juridical person. By the way, Abbas, good question raised.
Yeah.
If you go into Article 1 of the decree law, you will find the definition of person, where it says unnatural or juridical person. But interestingly, juridical person has not been defined in corporate law. So that's an open to interpretation expression used.
Okay, thank you.
A natural person owning stock with the rights to vote 60% of the company's stock. So, a juridical person who by contract or by stock is able to appoint 3 of the 4 directors. These are all examples of control. A natural person owning a stock in a company and entitling to receive 75% of the dividends paid, even if that person owns less than 50% of the company's stock. So see, even the highest amount of profit is coming to the person. So these are some of the examples or manifestations of control. A juridical person who by contract or by stock is able to exercise control over the company's bank account. I had one uh, tax impact assessment case where there was an airtight contract between an insurance broker and a BVI management company. It was incorporated in British Virgin Islands, and that management agreement was so airtight that the insurance broker could not have breathed without the permission of the management company. So, although that management company had no shareholding into that insurance broker, So in our impact assessment report, we clearly mentioned that this is a related party first of all, and if you really look about it, even the place of effective management of this company is British Virgin Islands rather than UAE, although it is incorporated in UAE, but it is being controlled from BVI. So these things can happen. There can be legal ground facts that we will need to consider. Okay, so now we're coming to connected person. Without prejudice to the provisions of the Article 28 of the decree law, a payment or benefit provided by the taxable person to its connected person shall be deductible only if and to the extent the payment or benefit corresponds with the market value of the service, benefit or otherwise provided by the connected person, as incurred wholly and exclusively for the purpose of the taxable person's business. This wholly and exclusively rule applies for any expense, right? Even if they had not written it, it would still be applicable because another article has provided this provision. But what was more relevant here in this article was that uh, the payment that we make to a connected person must correspond to the market value of the service. If the same market value of the service or benefit we can get in much lesser amount from a third party independent person, then it will create a major question on the payment that we made, that it is not in compliance with the transfer pricing law, and the company making the payment may need to make a reduction in the expense amount, so increasing of the profit. Now let us look at Article 36 clause 2. Meaning of the connected person is relevant because payments to connected persons are to be disclosed in the return. So the decree law defines the connected person as one of the four definitions. An owner of the taxable person, meaning shareholder could be their partners. For purposes of Article 36, the owner is any natural person who directly or indirectly owns an ownership interest in that person. Director or officer. Now here the word officer has been written, which is again subject to interpretation, but please understand that we are talking about key office holders here. So the C-suite basically. And whenever you talk to your tax clients and you tell them that directors are connected persons, fine, they will accept it, they will digest it, swallow it as well. But when you tell them that the officers, key officers are also connected person, even the person to whom you're talking, and usually it will be the CFO or the finance head, that person will be a bit laid back and in shock that CFO is also a connected person. Yes, the answer is yes. Any C-suite person who can significantly influence or control the business of the company, even that is a connected person. Even their salary is subject to this benchmarking rule. A related party of any of the persons referred in the paragraphs A and B, meaning if there is wife of the CEO, that is also a connected person. Okay, where the taxable person is a partner in an unincorporated partnership, a connected person is any other partner in the same unincorporated partnership. So naturally, I mean, all the partners in an unincorporated partnerships are connected persons to that partnership, and any person that is a related party of the partners. So even the spouses or daughters and sons of the partners will be seen as connected persons to that partnership. This is a repeat. I'm not going to take you into that. Now we're coming to arm's length principle, although we've discussed this, but anyways, okay. So instead of me repeating it, let's hear from you. What would be an arm's length transaction? How can you define arm's length? This we've discussed too many times, so I'm just going to take a recap from you guys. Kalima, what is arm's length transaction?
It's like sold at market price.
Market price. Knowledgeable willing buyers. it should not be a forced sale scenario. Okay, so yeah, so this is what is meant by arm's length. But transactions between related parties must meet arm's length criteria. This is Article 34. Article 34 is a key article, guys. Remember this, because this addresses, this lays down, this is the Article 34 is the foundation of the entire transfer pricing under the UAE corporate tax decree law, arm's length principle. The wording used in the decree law is similar to, but not identical with the wordings of the Article 9 of the OECD Model Tax Convention. So you need to remember that whenever we talk about Article 9 of the UAE Corporate Tax Decree Law, the corresponding article in the OECD Model Tax Convention is Article 9, which addresses what? Two aspects. One, associated persons. It defines what is meant by associated persons, and it also defines the arm's length principle. It also talks about control. A taxable person sells goods to a company which is neither related to nor connected with the taxable person for AED 1000 each, and sells the same goods to a related person for AED 850 each, then the arm's length standard price should be 1000 for each good. So, the reduction in price will be disregarded for the purposes of corporate tax methods. So, the 6 methods potentially available for the UAE taxpayers to use when calculating an arm's length considerations are described below. We we saw 5 different methods that we discussed earlier on under the OECD's transfer pricing guidelines. They will be repeated. This amount must be determined according to Article 34 by applying one of the combination of comparable uncontrolled price method. You remember CUP method, then resale price method, then cost plus method. First 3 of them, what were these called? If you remember, guys, these traditional transaction method. Yes, right. And then after that, what are we looking at? Transactional net margin method, TNMM, and transactional profit split method. Other 2 methods, what were they called? Transactional something method, right? Transactional profit method. These are the same as the 5 methods recommended by the OECD. Transactional profit method, this category. The taxable person may apply any transfer pricing method other than the methods listed in Article 34, where the taxable person can demonstrate that none of the methods reasonably applies to determine an arm's length result, and that any such other transfer pricing method satisfies the arm's length standard. Can you guys think of usually sometimes benchmarking becomes applicable, right? So in one of the clients, I had to resort to a method for comparing the salaries that were being paid to connected persons. And do you know what source I took? If you have a challenge and the client is worried that benchmarking may cost significant amount, for salaries you can source information from internet as well. Can you guys cleverly think that what could be that source where you could draw some comparability conclusions?
Glassdoor.
Sorry,
Glassdoor, maybe.
Glassdoor is okay. That may be acceptable if they are publishing such results. Yes. Yeah. So here in UAE, there are so many multinational recruitment and selection and headhunter agencies like Hayes or similar big names are there. They publish their benchmarking surveys on salary, and they even address industries. That is a very good source for you to benchmark salaries. You can refer to that. Relevant factors. Article 34 stipulates that the choice and application of the transfer pricing method or combination of transfer pricing methods out of the 5 plus any more methods must be made having regard to the most reliable transfer pricing method and take into account these relevant factors. What are those relevant factors? Contractual terms of the transactional agreement. Characteristics of the transaction or arrangement. So that's the spirit, this is the letter and spirit. Economic circumstances in which the transaction or arrangement is conducted. So functions performed, asset employed, risk. Can you guys recall what is that? Assumed by the related parties. The FAR analysis. Okay, by the related parties entering into the transaction or arrangement. Business strategies employed by the related parties entering into the transaction arrangement. These are the relevant factors to consider when you are performing a transfer pricing detailed analysis. While these broadly align with the OECD's approach, the UAE has been more direct in categorizing the factors to be considered. So let us talk a little bit about FTA audits. When the FTA is determining whether the taxable person's application of the transfer pricing rules to income and expenditure resulting from the taxable person's relevant transaction or arrangements satisfies the arm's length standard, FTA can apply Article 34(6) is to apply the method adopted by the taxable person under this same article, providing that the method is appropriate having regard to other factors, relevant factors. This approach is different to that adopted by OECD, which does not limit the tax authority to the taxpayer's chosen method. So, you know, OECD kind of allows tax authority to go beyond what has been the recommendation or proposition of the taxpayer. But let's be honest, that stage has barely reached in UAE. This is still December. Although yes, there are some companies which have to file those their tax returns by the end of December also. But after this deadline is achieved, then only consideration of transfer pricing or tax audits is going to start. And when the ground reality hits, there will be federal tax authority is going to exercise their powers, and they probably will go beyond the taxpayers chosen methods if they are unreasonably unfair. If the parties fix on one of the methods by taking into account factors other than the ones those in A to E, then methods chosen may not be acceptable methods. Naturally, I mean, the reasonableness will come into play. Application of the approved methods likely results in an arm's length range of the financial results or indicators acceptable for use in establishing the arm's length price between related parties. Uh, the article provides for a range to be subject to any conditions specified in a decision issued by the Federal Tax Authority. So anyways, whenever we conduct a benchmarking exercise to determine the arm's length principle, the results or findings is not one figure but a range of the price. So there's a detailed discussion is there, but the quartiles are developed and all that through the benchmarking. There are multiple results that are organized in terms of quartiles, and then the middle two quartiles are considered. The first and the fourth quartile are excluded because they are extremes. Adjustments. The decree law provides for the consequences of a transaction's terms not being arm's length by granting permission to the tax authority to reconstruct the price by making so-called transfer pricing adjustments. So once the whole point is that if FTA, Federal Tax Authority, is not satisfied by the method chosen or the result arrived, they can reconstruct the pricing. And once they have reconstruct the pricing, they may come back to the taxpayer saying that you need to make transfer pricing adjustments and thereby either increase your profit or decrease your profit. But FTA is not going to ask anyone to decrease their profit, by the way. So domestic adjustments, when the transaction arrangement pricing between related parties is outside the arm's length range, FTA, as permitted by Article 34, can adjust taxable income to achieve arm's length result. The best that best reflects the fact and circumstances of the transaction. The same Article 34 provides that when making adjustments, FTA must rely on information that can or will be made available to the taxable person, and when an adjustment is made either by the FTA or by the taxable person, FTA acting under this article is to make a corresponding adjustment to the taxable income of the related party. Why? Because naturally it's a transaction between related parties. So not one but two companies are involved. So if FTA and revenue authorities of the world are fair in this regard, if you are asking one company, for example, to increase their profit, then naturally the other side of the transaction is going to affect the other party. I mean, they'll same, if one company's profit goes up, the other company's profit will go down. So that's the concept of corresponding adjustment. So the English equivalent of the Arabic words suggest that the FTA is required to make an adjustment, but a gentle caution that the Arabic wording may not be as helpful to the taxpayer and should be monitored. Example, if the actual related party transaction sale price is 85,000, but the arm's length price is higher, which is 6,000, and the consideration is increased by 1,000, then the FTA is to reduce the taxable income of the related party by 1,000. So this is a corresponding adjustment. In one party's books, the revenue will go high, and in the other party's books, cost of sales will go high. Transfer pricing documentation. Under Article 55, which is the article for transfer pricing documentation, can you guys remember that the mention of Article 34 and Article 55 has been included in the 5 conditions of a particular article which addresses a special regime? What is that article of the decree law? What is that regime of the decree law?
Qualifying free zone.
Very good, very good. So qualifying free zone person. Why? Can you elaborate, Kalama? What does that provision say? Which article is that, by the way?
I think Article 18.
Very good. Article 18 is that article which addresses qualifying free zone person regime, and in that article, they say that in order for a company to become qualifying free zone person, 5 conditions must be met. One of those conditions was regarding Article 55. What was that condition? A qualifying free zone person must comply with the requirements of Article 55 and which other article?
34.
34. Very good. Which was for what? Arm's length principle. Please remember, guys, these two articles, Article 55, which addresses transfer pricing documentation, and another article which we've been reading this article for so long time, Article 34. You see this? This is Article 30. So many required. Article 34 is arm's length article. Okay, arm's length principle. So these two articles must be complied in order for a company to be compliant with the transfer pricing rules. Under the transfer pricing documentation, we read some examples of transfer pricing documentation. Can you guys recall what we read? We read about master file. We read about local file. We read about one more thing. What was that?
Uh, Country by country.
Country by country reporting. In UAE's case, there is one more documentation for transfer pricing. Can somebody think of it? We have to file that document together with the tax return.
Related party disclosure form.
Transfer pricing disclosure form. Maybe the nomenclature may differ, but yes, that's what it is. So under Article 55, FTA may, by notice or through a decision issued by the FTA, require a taxable person to file together with their tax return a disclosure containing information regarding the taxable person's transactions and arrangements with the related parties and connected person in the form prescribed by the authority. So that's another return basically which we have to file together with the corporate tax return. So the filing with the FTA for transfer pricing documentation is not automatic. It is dependent upon receiving a request. Okay, so that's what we should remember. There will be a request to file the form. If a taxable person's transactions with its related parties and connected persons for the tax period meet the conditions prescribed by the minister, taxable person must maintain both master file and local file. There is a decision, ministerial decision number 97, which is on requirement for maintaining transfer pricing documentation for the purpose of the federal decree law on taxation. And what does that say? A taxable person that meets either of the following conditions shall maintain both master file and local file in accordance with Article 55. So, what are those conditions? Where a taxable person for any time during the relevant tax period is a constituent company of a multinational enterprise group as defined in the cabinet decision 44 of 2020 referred to above, that has a total consolidated group revenue of 3.15 billion dirhams, which is equivalent to how many euros?
750.
750 million euros or more in the relevant tax period. But please remember, constituent company in the title case, meaning this is that company which is defined under BEPS Pillar 2 framework of a multinational enterprise. This is that multinational national enterprise which is earning 750 million euros or more. So if a company, then it will not matter how much is that UAE entity's turnover, because the group turnover has exceeded 750 million euros. Okay, that company, no matter how small the revenue, they will need to file. They will need to maintain transfer pricing documentation. They will maintain master file. They will maintain local file. They will even file CBCR, country by country reporting. But this is the interesting part, which I had mentioned to you guys earlier, if you remember, where a taxable person's revenue. Now there is no mention in this about multinational. Can you see, right? It does not say MNE. It does not say constituted entity. Where a taxable person's revenue in the relevant tax period is AD how much? 200 million or more. Then by default, maintaining a master file, local file, everything, all the transfer pricing documentation will become applicable. Ministerial Decision number 97 of 2023 on prescribes additional conditions that need to be satisfied for maintaining master file and local file. Should the FTA require information, that the time to file is brief. So Article 55 provides for the documentation to be submitted to FTA within 30 days following a request from the FTA to do so, or by any such other later date as the FTA directs. That is why, if you remember, we had read earlier contemporaneous maintaining and updating of the documentation, transfer pricing documentation. So as soon as a transaction happens, you guys should update it, update the comparability data and other compliance data for the transfer pricing. If the FTA requests a taxable person to do so under, then the Article 55 requires the taxable person to provide FTA with the information to support arm's length nature of the transaction or arrangement within 30 days following FTA's request. Taxable person will be required to maintain master file and local file if it meets the conditions for doing so laid down by the minister, and must file them with the FTA within 30 days. Now we're coming to CBCR, country by country reporting. BEPS Action 13, we need to remember this point, okay? BEPS Action 13 requires large multinational enter groups of entities, MNEs, to file country by country report to provide a breakdown of the multinational group's global revenue, profit before tax, income tax accrued, and some other indicators of the economic activities for each jurisdiction in which the MNE group operates. OECD has recommended all countries introduce the report, and this section summarizes. Let's have a look at report's purpose is to eliminate any gap in information between the taxpayers and tax administration with regard to where the economic value is generated. You know, guys, whenever you go into OECD's guidelines, you will read this again and again. Generation of economic value, especially on intangibles as well. A lot of guidance has been provided because now the digital era is here. So the generation of economic value is a key aspect. So country by country reporting addresses this, that an entity which is operating in UAE, for example, how much revenue was contributed because of their presence in UAE. So that begs the question, what about those branches that are here? So just to let you guys know, a number of insurance company, multinational insurance companies, they are operating in UAE by way of branches rather than setting up a proper LLC here, right? So these are only branches. When we say branches, they are extension of their original companies located in uh, their respective countries. So Mr. Nazar from Qatar is here with us. So Mr. Nazar, Qatar Insurance has been my client, for example, and they are operating in UAE by way of a branch structure. Can I
Okay.
ask? Can I ask you a question here? Let's say that's Qatar Insurance branch in UAE. Okay, they are selling insurance contract. They are giving insurance coverage to somebody sitting in USA. Okay, would you consider
Yes.
this income as an income that that should be subject to tax in UAE, or should it be subject to tax directly in Qatar?
In UAE,
And why do you say that?
because the income source is in UAE.
Right. So, okay. I mean, maybe you wanted to say that uh, the reason that this income has come into play or being recognized by the this multinational enterprise is because of their presence in UAE. The UAE team, FAR analysis, functions, assets, risks, right? So the UAE team of Qatar Insurance branch is not only performing all the functions, they are deploying the assets that they have in their balance sheet, which is investment, for example, right? All the insurance companies have investments, and they're assuming all the risks for that. God forbid if that beneficiary dies, who's going to pay the claim? It is the UAE branch of Qatar Insurance that is going to pay. All the FAR criteria, FAR criteria is being met for the UAE branch itself. So it is UAE's income. You're right. Okay. So, the UAE Ministry of Finance introduced the CBC reporting through a cabinet resolution number 44 of 2020, organizing reports submitted by the multinational companies concerning the regulation of the submission of the report by multinational companies when it adopted action 13 of the OECD G20 BEPS initiative. UAE has complied with the international tax governance. So guys, UAE, by the way, is a member of the inclusive framework. You guys know what is inclusive framework, right? Have you heard about it? Can somebody tell me what is inclusive framework?
I think they do not follow all of OECD's recommendations, or I think it was something along these lines.
Yes. So basically, when the BEPS report came, or BEPS action plan came, 139 or 140 countries of the world basically signed on an agreement, a protocol that was called the inclusive framework of OECD, of BEPS action plan. So OECD only has maybe around 40 countries which are the members of the OECD. Other countries are non-member countries. They are not members of the OECD, but they are, because of the virtue of signing this protocol, they became members of the inclusive framework of OECD. So UAE is a member of the inclusive framework, but not a member of OECD. But do you, Abbas, do you know the history of OECD and the role of G20 countries?
No, I'm not fortunately, not really.
So OECD, Organization for Economic Cooperation and Development, was actually founded by the G20 countries actually. So, and what I'm going to give you a hint, one of the GCC countries is a member of the G20 countries.
Saudi Arab, right?
Saudi Arabia, yes. So yes, Saudi Arabia is a member of the G20. So that should be in knowledge. So the entities to report, the report, when they say report, they mean CBCR. Are two or more companies having tax residence in different jurisdictions, or one single company having its tax residence in one country but subject to tax in another country on profits of the activity located in that other country. So yes, foreign source income. Uh, Multinational enterprises we're talking about. CBCR is filed by multinational enterprises. Uh, the decision of the UAE Council of Ministers as amended was to require MNEs meeting certain requirements, including consolidated revenues of more than 3.15 billion, which is in euro terms, it is different, 750 million euros, to prepare and submit the report to the UAE Ministry of Finance. This is known as the UAE Competent Authority, Ministry of Finance. The ultimate parent MNE sets up the linkage with the ministry by notifying the minister of its filing status no later than the last day of the reporting period. Uh, and the MNE Group's reporting entity, ultimate parent entity, must file the report in the UAE within 12 months. This is a key point for us to remember. This is the time limit allowed. So CBCR report must be filed within 12 months following the last day of the reporting fiscal year of the MNE group. So we have to find out what is the MNE group's fiscal year, and then we have 1 year to file the CBCR, country by country reporting pertaining to that. So if there is a report pertaining to the fiscal year 2024, what would be the deadline? End of 2025. By December 31st, 2025, country by country reporting related to the year 2024 must be filed with the UAE Ministry of Finance. In the UAE, the requirement to report commenced for the financial reporting year commencing 1 January 2019, with the first report to have been submitted by the 31st December 2020. So by now, qualifying entities could have filed report for 3 years, actually now 4 years. UAE reporting threshold. UAE's reporting threshold broadly aligns with the 750 million euros reporting threshold. Let's look at the contents of the country by country report. Article 3 of that cabinet resolution requires that report to include aggregate information related to the amount of revenue, profits or losses before income tax paid, income tax accrued, stated capital, accumulated earnings, number of employees, non-monetary or cash equivalent tangible assets in the respect of each country in which MNE group carries out its activities. Identification of each constituent company of the MNE group, indicating the jurisdiction of tax residence of that constituent company. So MNE group will have multiple subsidiaries or companies that are part of it. So they are known as the constituent companies or sometimes constituent entity. And where different from the jurisdiction of tax resident, the jurisdiction under the laws of which such constituent company is established. And one more thing, the nature of the main business activity or activities for each of the companies. So it's a very comprehensive report, has to be filed with the Ministry of Finance. The UAE has adopted the OECD report form by requiring that it must be in the form and adopting the definition specified in the standard template in OECD's transfer pricing guidelines. So it's a very detailed document, OECD transfer pricing guidelines, and it provides the report format of country by country report and any amendment thereto. UAE has aligned the contents of the CBCR with the contents required by the OECD. Report use and confidentiality. Article 5 of the UAE Competent Authority is to use the report to fulfill any of the assessing the transfer pricing which it considers to be high risk, assessing other risks associated with the BEPS in the UAE BEPS. What is the pullout of BEPS? Anybody? base erosion and profit shifting. So, erosion of the tax base basically, and shifting, unfair shifting of the profits. Assessing the risk of non-compliance by the multinational enterprise group members entities with applicable transfer pricing rules. So, non-compliance can happen, so it has to be assessed. For economic and statistical analysis purposes, the competent authority shall not, when carrying out transfer pricing adjustments, rely on that report. It shall not rely on the report. I mean, naturally, there will be a much more detailed analysis performed if transfer pricing compliance or adjustments are being reviewed. These uses align with the OECD's templates. The UAE competent authority is required to preserve the confidentiality of the information contained in that report, at least to the same extent that it would apply if the same information had been provided under the Multilateral Convention on Mutual Administrative Assistance in Tax Matters. So, basically, this is a matter of information exchange. So, TIAs, Tax Information Exchange Agreements. Yeah. Anybody saying something? Okay. Again, this aligns with the UAE with the OECD practice. So, there are very clear guidelines provided by OECD on how information exchange or confidentiality has to be adhered by the countries who have agreed to comply with the OECD recommendations. So, UAE also follows the same. UAE competent authority has undertaken that the UAE will use the report information in accordance with the permitted uses, only permitted uses, and has also undertaken that it will not use reporting data beyond those limitations. UAE's proposed uses of the report are aligned with the international tax governance mandated uses, and the UAE has undertaken to apply the standards of secrecy for the data incorporated in that multilateral convention for mutual administrative assistance in tax matters. Now, we are coming to records and penalties that are applicable to transfer pricing. Powers of the competent authority to request information and access. Article 6 of the Cabinet resolution provides for the UAE competent authority to request information. It's not only Article 6 of the Cabinet resolution, but as a matter of fact, decree law also, UAE corporate tax decree law also requires this from reporting entity. But that decree law talks about the entire tax matters, but this cabinet resolution was purely for CBCR, country by country reporting. So, entities must provide information under this cabinet resolution. Reporting entity or access its premises or place of work in order to determine whether information provided and included in the report is accurate or complete. So, the Ministry of Finance can even access by entering the premises. Ensuring any information not included in the report was omitted for a valid reason. Inspecting the procedures adopted by the reporting entity as part of ensuring the latter's compliance with the obligations stipulated under this resolution. So, these are the mandates given to the competent authority in UAE to assess whether information is correct on the CBCR. Maintaining records. So, from article 5, every reporting entity is to maintain the actual records for 5 years. Yeah, but 5 years is the statute of limitation in UAE. After the date on which its report has been submitted in the UAE competent to the competent authority, and the reporting entity may retain the records electronically, provided these records are prepared in an electronically legible format in accordance with the laws and regulations relating to the retention of electronic records in force in the UAE. Nowadays, in all fairness, the entire record maintenance is digital. Hard copy days are over. An administrative penalty is imposed on the reporting entity that fails to comply with the obligations set out in the resolution. If the reporting entity fails to meet the deadline specified in the resolution, it is liable to pay on administrative penalty of 1 million dirham. So, failure to file the return within the 12 months. UAE dirhams 10,000 for each day thereafter that the failure continues, with a maximum of 250,000 dirhams. An administrative penalty of UAE dirhams 100,000 if the reporting entity fails to maintain the documents and information required to be collected in course of meeting its reporting obligations under this resolution for a minimum period of 5 years. So, if you fail to maintain the record for 5 years, 100,000 dirhams penalty. After the date of the reporting, the report to the competent authority. The entire administrative penalty listing is considerably broader than those briefly described here. More penalties are there, with the penalties of failing to file the report on time being very substantial, and for the failure of retaining the records for the required period, M&E groups must implement early a system and procedure to gather all the required information to avoid failing to file on time, and must establish a record retention policy and approach to ensure compliance. Naturally, that the failure to file CBCR penalty was as big as 1 million, so huge. CBCR guidance. The UAE guidance on preparing and submitting the report is published as guidance for compliance with the CBC regulations. There are MOF. There, the MOF, Ministry of Finance, confirms that the OECD guidance on the implementation of the CBC reporting can be used to interpret the UAE CBC reporting legislation. So, in short, it is the OECD guidance provided in the transfer pricing guidelines that overrides. That's the mother, regulation. In so doing, the UAE is aligned with the OECD's approach and should result in a consistent and standard approach for CBC reporting. Ministry of Finance confirms there are some differences between the OECD model legislation and the UAE CBC reporting legislation, and in those circumstances, UAE CBC reporting legislation take precedence. So, you might have heard this from me before, and it is common information as well. International law is a customary law. It only becomes binding when Vienna Convention comes to force it. Otherwise not. CBC reporting is an internal legislation that has been enacted by UAE. So that's how it is. It is not under a multilateral or bilateral treaty. Now we are coming to dispute resolution mechanisms. The Decree Law 47 includes provisions by which a taxable person may obtain a clarification from the tax authority. Guys, this is very important, especially for the larger entities, because they are heavily exposed to transfer pricing risks. May obtain clarification from the tax authority, as well as provisions for the levying of penalties where a provision has been violated. So, Article 59, like honestly speaking, nobody cares about the latter articles, especially the administrative articles, but for multinational enterprises, for larger entities, these articles are very, very critical. Article 59 of the decree law provides for two instances in which a person may seek clarification. Article 59. A person may apply to the federal tax authority for a clarification regarding the application of the decree law or the conclusions of an advanced pricing agreement, APAs, very critical, with respect to transactions or an arrangement proposed or entered into by the person. So, you are about to do a transaction with a cross-border related party, for example, or even a domestic related party, which are called what exactly in the Model Tax Convention? Can somebody quickly answer this? What is the name used in the Model Tax Convention for related parties? Come on, guys, you need to be quicker than that. Associated enterprises.
Associated.
The application under the first thing is advanced pricing agreements. The application under clause 1 of the article shall be made in the form and manner prescribed by the authorities. So format has been provided. The pre-transaction clearance and advanced pricing agreement represents devices available to a taxable person. This is very important. I think a very small fee applies, 2,000 dirhams or something. And after this, the company will be able to avoid a huge exposure available to the taxable person to reduce the risk of the FTA adjusting a tax return and following on by charging an administrative penalty. By spending this small amount and doing some effort, you can avoid huge transfer pricing exposure. Violations and penalties. Article 60 of the Decree Law 47 2000 provides a person to be subject to corporate tax assessment in, in accordance with the tax procedures law and the decisions issued in the implementing of its provisions. So there are, please remember, there is a tax procedures law. I think it is law number 28 of 2023. And then later on there were executive regulations also issued for that law. So any tax assessment will be opened up or carried out under the tax procedures law. Notwithstanding the provisions of the tax procedures law, tax procedures federal law number correct, but the year I said incorrectly. For tax procedures federal decree law number 28 of 2022 issued 30th September 22, but it was effective on 1st March 2023, and the decisions issued in the implementation of the provisions, FTA may prescribe the circumstances and conditions under which a corporate tax assessment may be requested by a taxable person or issued by the authority. So let me ask you a question. It's a very interesting and fine line of difference question. Is this the same as tax audit? Can somebody answer this? Abbas? A tax assessment, is it same as tax audit? No, it is not.
No.
It is not. Sometimes it can happen that the FTA may simply perform an assessment. It can reassess, or sometimes even the taxpayer may say that, look, this is our assessment that we have filed, but can you please do the assessment? You know, it can also. At the date of writing, no such prescriptions have been issued. Until now, it has not happened. But let me tell you, in my practice during the previous years, tax assessments I have seen. Even for VAT also. So FTA can open up tax assessments. Okay. The tax procedures law shall determine the relevant penalties and fines relevant to the implementation of the decree law number 47. Penalties for breaching the corporate tax decree law are contained in tax procedures law of 2022. There is a very detailed schedule of penalties that has been provided in the tax procedures law. So far as is relevant to breaching the transfer pricing provisions under Article 24 of the Tax Procedures Law, which establishes the administrative penalties. The FTA can issue an administrative penalties assessment within 5 business days of for any of the following misdemeanors. So these are simply, it may not be directly related to transfer pricing, but in general these are the violations that a taxable person can do, and they will be issued a penalty. Incorrect tax return. Registrant, the taxable person submitting an incorrect tax return, incorrect associated transaction would constitute an incorrect tax return, right? So now it is the course author is connecting basically with the transfer pricing. So by saying that incorrect associated transactions, meaning related party transaction, would be constituted as an incorrect tax return, filing of the incorrect tax return. Errors in voluntary disclosure. Taxable person or taxpayer submitting a voluntary disclosure in relation to errors in the tax return or the tax assessment or refund application. This can be errors in voluntary disclosures, that could be a non-compliance. Failure to submit. The taxable person or the taxpayer fails to submit a voluntary disclosure in relation to errors in the tax return. You found out that one error happened which warranted a voluntary disclosure and you did not disclose it. that will be constituted as a violation. Or the tax assessment or refund application pursuant to tax procedures law before being notified that he will be subject to a tax audit. This is very interesting. This is actually a case that I also handled actually, that in one particular case related to VAT, the taxpayer, tax audit had gotten opened for a taxpayer, and the advisors did not know about this provision, and it is a very well known name of UAE. I don't want to take the name, even it is considered as one of the top 20 firms of the world, and the tax partner over there, they advised, you should file a disclosure, voluntary disclosure. It was a blunder, huge blunder. Once the tax audit is opened, and then you accept your mistake, saying that, oh, we did a mistake, so we are filing a voluntary disclosure. FTA looks at it in a very negative manner. So the case got even worsened because of this wrong advice. So if you cannot file a voluntary disclosure after the tax audit has been opened, this would apply were incorrect associated transactions not notified to the tax FTA before being detected in an audit. If the tax auditor has already detected something, you cannot then later on become naive and innocent and try to file a voluntary disclosure for that other violation. Any other violation specified under the tax law. Tax evasion. The penalty for tax evasion is substantial. Under Article 24 of the tax procedures, the amount of any administrative penalty shall not exceed 2 times the amount of tax in respect of which the administrative penalties assessment was issued, together with the payable tax in accordance with the provisions of the tax law. So what should we remember? The amount of administrative penalty will not exceed 2 times the amount of tax in respect of which that penalty was issued. Key point for us to remember. Tax evasion. I think by now we all know what is the difference between tax evasion and tax avoidance. But just for recall purposes, who is going to quickly repeat this?
Tax evasion would be illegal and tax avoidance would be done through manipulating, let's say, the tax laws.
Tax evasion is straightforward, basically a crime. So you are stealing tax. You're not even reporting transactions or other tax base, because and in doing that, basically preventing payment of tax to the authority. That's tax evasion. But tax avoidance is when you're still within the confines of law. And for example, Abbas, would you consider splitting of a company into two companies so that both companies remain below the 375,000 dirham threshold as tax avoidance?
Yes.
Yes. So that's a good example of tax avoidance. So one company was earning, let's say, 400,000 dirhams, which would be subject to corporate tax. So the shareholder said, okay, let's divide it into two companies. Each company will have 200,000 revenue. So that means both companies will fall below the 375,000 dirhams per annum threshold. So we will not be required to pay tax. That's tax avoidance, remaining within the law. So anyways, let's start this. The penalty set out in this decree law shall not prejudice any more severe penalties applicable under any other law. So there is civil code of UAE, there is criminal code of UAE other than the tax law. So there may be other penalties that may be applicable and they will stand true. They will still hold. A prison sentence and a monetary penalty not less than the amount of evaded tax and not exceeding 3 years, not exceeding 3 times of it, or either of the two, shall be imposed on any person who has committed tax evasion by any of the following acts: deliberately understating the actual value of the business, actual value of his business or his revenues, or failing to consolidate his related businesses, with the intent of remaining below the relevant registration threshold, tax rate or other tax threshold as specified in the tax law. So basically, misreporting of the figures, deliberately decreasing the due tax calculated and payable under the decree law, or participating in any form of tax evasion, deliberately committing or omitting any other act which may constitute tax evasion under the decree law. Basically doing anything to avoid paying tax or steal criminally. A prison sentence and a monetary penalty not less than the amount of the administrative penalty and not exceeding 3 times of it. 3 times is being repeated, that's the cap, or either of the two shall be imposed on any person who deliberately does not settle a due administrative penalty unless a decision is issued waiving thereof. One administrative penalty was issued, that penalty was also not paid. So there will be another penalty on top of that penalty. So that's this is quite strict. A prison sentence and a monetary penalty not exceeding 1 million dirhams, huge, or either of the two shall be imposed on anyone who commits any of the following acts: deliberately provides false information, data and incorrect documents to the authorities, conceivably depending upon the nature of the transfer pricing behavior, the FTA could apply this penalty. Transfer pricing has a major area of manipulating. If any of the acts in the previous clause has occurred which resulted in tax evasion or facilitating or concealing tax evasion, the penalty set out in clause 2 of this article shall apply. So similar, monetary. Any person proven to have directly participated or caused any of the crimes set out in the decree law or the tax law shall be penalized with the penalty prescribed by the decree law number 47, which is the federal decree law, in accordance with the provisions on criminal participation stated in federal law number 31 of 2021. So that's a different law. I think this is the civil code, I think. Without prejudice to clause 11 of this article, anyone who has participated in a tax evasion crime shall be jointly and severally liable with the person with whom he participated to settle the payable tax and administrative penalties. So jointly and severally liable, any, how do you say, those people who support in crime, basically, jointly and severally liable. The court may, upon conviction, publish the judgment or its summary by a suitable means. The judgment to impose a penalty under the provision of this decree law or any other law shall not exempt any person from the liability to settle any payable tax or administrative penalties. So, any other law penalties applied under other laws, the person will still be subject to settling those. Were the transfer pricing to be intentionally wrong for the purpose of intentionally reducing tax, then a penalty of up to 3 times the tax due plus the tax could be levied on the taxable person. So original amount of levy plus 3 times penalty. Let us take again. Right, we are on the questions now. Select the correct answer to complete the sentence. Article 59 of the decree law, if you remember, what was that? We discussed about APA, advanced pricing agreements, etc. Provides 2 instances in which a person may seek clarification. So what were those? To ensure that MNEs are not taxed more than once on the same income, to ensure that MNEs complies with the laws and administrative requirements in different legislations, to ensure that MNEs allocate income and expenses in a manner that reflects open market conditions, to ensure that tax administration can obtain pertinent data located outside their own jurisdiction. So which one is correct? This is double taxation to ensure that revenues are not taxed more than once in the same income. For this, foreign tax credit provision is applicable. So this is double taxation. To ensure MNEs comply with laws and administrative requirements in different jurisdictions, that was not Article 59. We were talking about advanced pricing agreements and transfer pricing matters. So probably this will be the right one, to ensure that MNEs allocate income and expenses in a manner that reflects open market conditions. So this is advanced pricing agreement. This naturally has nothing to do with this, is information exchange. Okay. Let us look at the second one. Which of the following is not an article that chiefly affects the taxation of multinational enterprises in the OECD Model Tax Convention on Income and Capital Gain? The name of article they have given, that's an easy one. Article 4, which defines residence, naturally this is not the one. Article 5, which determines the taxation of permanent establishment. Article 8, which relates to the taxation of capital gains. Article 9, you remember I mentioned Article 34 of the corporate tax decree law and Article 9 of the Model Tax Convention, which defines what? Associated enterprises and the concept of control and those things. So Article 9 is the correct answer. Oops. Article 8, which relates to the taxation of capital gains, is no, I read the question incorrectly. Which of the following is not an article? Oh God. Okay, Article 9. Okay. Select the correct answers. What is the main purpose of the OECD's guidelines on transfer pricing? What is the main purpose of the, okay, to help tax administration and MNEs to find mutually satisfactory solutions to transfer pricing cases, avoiding costly litigation. I remember this was the correct one. To encourage taxpayers to follow these guidelines in evaluating for tax purposes whether their transfer pricing complies with arm's length principle. What is the question? What is the main purpose? I think this is the correct answer, litigation. To provide guidance when a corresponding adjustment request has been made to determine the allocation of the burden of proof in transfer pricing cases. Main purpose is avoid litigation and all that. Okay. Select the correct answers to complete the following statement. Which of the following statement is true about OECD Model Convention? Article 9, which is true? Okay, let's see. It applies only to transactions between two independent enterprises. No, it applies to associated enterprises. Begin with, this is eliminated. It allows for an adjustment of profits between associated enterprises when commercial or financial conditions differ from those between independent. This seems to be the right answer. It requires automatic adjustment of profits in state A, in state B if the profits of state A. No, it does not allow automatic adjustment of profits. Not this. It only applies to profits earned by an enterprise of a contracting state in that state. No, absolutely wrong. So this is the correct one. It allows for adjustments of profit between associated enterprise when market conditions are different from the associated. Yep. Let's go to the next one. Select the correct answer. Which of the following is not a traditional transaction method established by the OECD? So if you remember, two things were there. One was traditional transaction method, other one was a transactional profit method. So CUP is a traditional transaction method for sure. Resale price is a traditional transaction method. Cost plus is a traditional transaction method, but transactional net margin was the second category, transactional profit. So this is not a traditional method. Yep. Okay. What is the other? Which of the following would qualify as related parties under Article 35 of the Taxation of Corporate Law? Two natural persons who are related within the second degree of kinship. It was fourth degree of kinship. Okay, the natural persons and a juridical person where the natural persons owns less than 50%, wrong, at least 50%. Two or more juridical persons where neither directly or indirectly owns 50%. No, it should be either directly or indirectly owns 50%. A person who is the trustee, founder, settler or beneficiary in a trust or foundation. Yes, this was correct. So these are these will be, these would qualify as related. Yes, these will be related parties. Let us look at the next one. When must an ultimate parent entity file the CBC report in the UAE? I think it was 12 months after the M&E's fiscal year. Let's see, within 12 months following the last day of the reporting fiscal year of the UAE competent authority. No, that is Ministry of Finance. No later than the last day of the reporting period. No, that was not the case. Within 6 months following the last day of the reporting fiscal year of the ultimate. No, that was not the case. Within 12 months following the last day of the reporting fiscal year of the M&E group. This is correct. Capital answer is again is wrong. Okay. Then we come to question number 8. Select the correct answer. What is the purpose of the pre-transaction clearance? Yeah, that I think they are referring to the advanced pricing agreement and the advanced pricing agreement. So what is the purpose? To reduce the risk of FTA adjusting the tax return. That seems correct. To ensure the taxable person does not pay any tax, to avoid paying penalties for incorrect tax returns, to prevent the FTA from conducting a tax audit. I would go with this one, uh, to reduce the risk of FTA adjusting the tax return. Okay. Then the next one, select the correct answer. What is the penalty for committing tax evasion under the transfer pricing matter? Okay, a prison sentence and a monetary penalty not less than the amount of the administrative penalty and not exceeding 3 times of it, or either of this seems to be the correct answer. A monetary penalty not exceeding 1 million dirham, uh, a monetary pen, uh, penalty not less than the amount of evaded tax and not exceeding 3 times of it, or either of the two. Hold on a second. What is the penalty for committing tax evasion under the transfer pricing matter? Tax evasion. Guys, what do you think? Which one should be selected? A prison
First
sentence.
one.
Sorry,
The first one.
first one. A prison sentence and a monetary penalty not less than the amount of the administrative penalty. No, 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 no. This is administrative penalty. No, no, no. You remember, Kalima? There was one case where the administrative penalty was also not. No, I think this is the correct one. Monetary penalty not less than the amount of evaded tax, and let's see. Yeah. Please select all that apply. What circumstances may lead to a corporate tax assessment being requested or issued by an authority? What circumstances may lead to a corporate tax assessment? At the discretion of the FTA, in accordance with the tax procedures law and its provisions. Yeah, this is correct. Uh, this is a gray area. As prescribed by the tax law or a cabinet decision. Yeah, tax law. Yeah, every assessment will be under tax law. If the taxable person fails to submit a voluntary disclosure before being notified of a tax audit, yes, this is correct. Upon submission of an incorrect tax return or voluntary disclosure, yes, this is correct. Discretion of FT, I'm not too sure about it. That without any reason, FTA cannot open. Do you guys agree, or what do you think? No answer. Okay, let's go. Yep. Circumstances that may lead to a corporate tax assessment being requested or issued by the authority are as follows. In accordance with the tax procedures law and its provisions, can be prescribed by the tax law or cabinet decision if the taxable person fails to submit a voluntary disclosure before the notification of audit, any incorrect disclosures. Okay, that's about it. Okay, great. So today's transfer pricing, session was quite important, and we have been able to read through all of the, objectives of the course. So inshallah, let us meet up on the next Sunday with the next module. Thank you very much, guys. Okay, take care. Bye bye.
Thank you.